There are opportunities for this rally to go longer and higher than you would expect.
It's not a strong growth picture. It's a grind, but I think it stays positive.
We're not as comfortable as I think the market is that the Fed is done here, that they will get inflation under control, that we will have a recession.
If we are going to see a recession sometime this year, I don't think that's priced into the S&P at all.
If the data continues to moderate and inflation continues to fall, that's your hike and pause and March scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
I heard in Variety magazine that you didn't like me and you were staying away for an extra day.
I stayed away for an extra day. My people talk to you. I'm going to tear up here, folks.
You've got to stop leaking.
It's the first time we've been together since the market didn't go down.
You've got to stop leaking. Your people just, telling Variety magazine. Equity futures this morning. Good morning. We are negative by 0.5% on the S&P 500. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. TK, welcome back. Good to catch up. Massive week ahead. Brown and I did that yesterday. You want to pick up on that story now?
Yeah, I'll pick up on it today and just say Monday, wait, Tuesday, wait, and then tomorrow the festivities start. And it is a very, very important week. And I think Jobs Day, with its wage dynamics, is maybe Chairman Powell wishes he was having this meeting next Monday rather than Wednesday.
I'm with you, Tom. I'm with you. He'd like the data. You've got Steve Englander over at Standard Chartered, TK, saying that maybe we could have a pause at the March meeting. Is this the final hike of this cycle?
It's under debate. It's under just, Anna Wong's out with Bloomberg with her historic call on a way above 5%. She absolutely nailed that. And, I don't know what the dynamic is. And what's important, John, I look at the Bloomberg today, the screen, the market doesn't know what the dynamic is. And, the press conference tomorrow is not going to be a small item.
Well, this market has been ahead of the projections of the IMF, that's for sure. The IMF calling this one, Lisa, a turning point for the global economy. And you have to say that's backed up by the data out of China a little bit earlier this morning.
It's backed up by the data out of China. It's backed up by the data out of the European Union, where you can see growth coming in better than expected. It's not backed up by earnings, at least not in the U.S. And that's what I find interesting. There is a divergent story that underpins the currency move that you've seen, both with China and Euro doing really well.
You're missing the punchline. The United Kingdom flat on their back. I mean, even France.
I think she was just being kind, Tom. I'm not sure she missed it.
France went to a positive statistic. But, John, this really, and just in the zeitgeist of the last 24 hours, the idea of the Brexit effect away from COVID, away from the politics. They're at a footnote. Ganesha said a footnote at the IMF that the GDP slowdown was due to Tottenham. I get that. There's no question.
That was the punchline, by the way.
That's the actual punchline, sure.
Come on, it's a Brexit effect.
I think it's more than that, Tom. It's the fact that we've had to have tighter fiscal policy, tighter monetary policy. Negative 0.6% is the projection from the IMF. That's the IMF's view on things, but it's a real downgrade from the previous view back in October. When you look at the US, it's an upgrade. When you look at China, it's an upgrade for obvious reasons. And the UK seemingly jumping off the screen for everyone is the odd one out.
What did you observe in the United Kingdom? Did you observe?
Yeah, I didn't feel recession in London.
Exactly.
To be very clear, in London's still booming.
But when I was in Paris X months ago, I'm like, this is a slowdown? And they came in today with
a lot of people feel that
data.
way. The BOE is still set to hike on a Thursday. The ECB is set to do the same thing. I don't think Europe's out of the woods either, before we get excited about that. Bramo, you look at the inflation figures from country to country over the last 24 hours. The ECB's still got work to do.
Which is the reason why the main question now is, what kind of reopening have we priced in? What kind of non-recession have we priced into Europe? And have we already gotten to the point where we've priced in more than we're actually going to see?
Let's whip through the price action for you briefly. Yes. Equity futures down 0.5%. To TK's point, the week really begins tomorrow with the Federal Reserve decision, a ton of earnings, then payrolls on Friday. Futures a little bit negative, adding to the losses from yesterday, but year to date we are still absolutely flying on the Nasdaq. On the Nasdaq 100, up by 8.9% over the last 4 weeks and change. Yields unchanged on a 10-year, 353.27, and euro dollar negative just a little bit here, TK, 108.26.
Yeah, two numbers. One, the Bloomberg Financial Conditions Index. I've seen this more in the media, which is good to see. There's other ones as well, but it's gone a little bit from accommodative back to ever so slightly trend towards some form of restriction. And the VIX, wanders back 20.58. We've given up that bull market glow that we saw in your sabbatical in England.
Is that a dig? Is that a dig?
It's not a dig.
Just right at the end.
I don't know.
Was that a
You and I
sabbatical?
got to go right back Sunday,
hang on a
February
minute.
5, Tots, Manchester
I was still working.
City at Tottenham.
I was still working.
Oh, you were working.
I was working.
Yeah, there's
Nasdaq
proof at
futures
Fulham.
a bit softer. Bramo, TK took too much time off, didn't he?
Oh, you're going to do a tit for tat there. I'll do a tit for tat as well and say that today absolutely the week begins 8:30 a.m. with employment cost index coming out for the fourth quarter of last year. This to me is going to be more interesting, sort of the under the radar kind of data to give a sense of how much wages are increasing and what the Fed can look at in terms of the inflationary pressure there. At 9 a.m. we get a bunch of housing data, including the S&P CoreLogic price data for the month of November. How much are prices coming down, or are we seeing a flattening out? Because if you talk to a lot of analysts, they've all been talking about how we've seen the worst, the biggest part of the slowdown in the housing market. If that's true, that sort of tailwind to keep inflation going lower, is it going to be as strong as some people had expected? Today, the earnings parade continues to roll out. We did just get UPS, which did give a worse than expected projection going forward, and those shares are dropping. After the bell, we get Advanced Micro Devices and Western Digital after getting NXP after the bell yesterday. To me, I am watching the semiconductors. NXP followed along with all of the others, giving a negative projection or a disappointing projection for the year ahead. Advanced Micro Devices and Western Digital will give some projection to give a sense there, but also really following on to what we heard out of Washington, the potential to restrict some exports to Huawei. Does that really affect some of their outlook as well, John?
Lisa, thank you. TK, what have you got?
UPS, I'm sorry, I'm going to go to this. This is use of cash through earnings season. Of course, we'll talk about this with this huge earning release, John, that we see. I believe it's in 2 days. UPS, share repurchase, capital spending on target, and a 6.6% dividend increase. They're falling apart.
A Snapchat later as well. Have you seen that stock year to date? The stock is up by almost 24%
I look
in 4 weeks.
at car sales, and tools, I look at Snap-on to do okay.
As for GM, which we get a little bit later, I believe we're catching up with the CFO. I'm going to let that go. You can't stop laughing. As for GM, Lisa, I think it's going to be very interesting if we get price cuts, more price cuts. That EV price war in the United States, for a lot of people, just starting to build.
So yesterday,
Very
Ford
cool.
coming out and following what Tesla had done, cutting some of their electric vehicle pricing. Is this a price war that's going to go beyond the auto sector? Is this just an EV sector? How much does this really cut into margins?
I know we got to get the yens. Ford, they're going to refund part of what the people who just bought the car overpaid
Oh, really?
for.
I missed that, Tom.
Yeah,
that's
it was
very
buried
cool.
in a paragraph. But to me, that's the headline.
That's very cool.
Basically saying to Elon Musk and you.
Tesla not
Can I say that
doing
on radio and TV? I don't know.
I think you just did. Jens
think I
Nordvik
just
joins
did.
us now, founder and CEO of Exante
Save
Data.
us, Jens.
Yeah, and Steve Englander this morning from Stan Chart. We think the incoming data will be soft enough for the Fed to pause in March. Do you agree?
I think the Fed doesn't want to signal anything in that direction right yet. They are in the process of slowing the pace of tightening, right? It's well telegraphed. They want to go 25. I think they view it as the first step here to signal in an orderly way that they're slowing. But I think they're going to be very careful about signaling that they're ready to pause and cut before they know it's the right time.
Yes, to your magisterial work on Europe over the decade, how constrained is Christine Lagarde? How limited are her degrees of freedom in moving forward?
I think we can see it from the inflation data we've had so far in January, right? That core inflation is dramatically above target, right? And the ECB has its roots in the Bundesbank, right? It's an inflation targeting central bank with no dual mandate. So they don't have much wiggle room. They need to go aggressive. And they've signaled, obviously, that they are on a pace of 50. Even if Fed is slowing to 25, they're going to continue to go at 50. And that could be for the next 2-3 meetings. And that will finally start to take the rate in Europe into restrictive territory.
So when you talk about the euro at this moment, how much do you price in the downturn that you could potentially see as a result of a tighter ECB policy, as well as some of the more negative pressures coming in, really revealing themselves more directly?
Yes, it's been a very interesting situation around growth in Europe, right? Because we've had incredible pessimism about the energy shock and also the effects of tightening, right? But the reality is that we've had barely any negative GDP readings. And now the energy prices have actually reset low, right? Natural gas prices, including in futures, are essentially back to before the Ukraine invasion. So there's a number of the tail risk factors that people were incredibly concerned about that have actually receded. So we obviously have monetary tightening in the pipeline, but some of the other growth drags are actually abating. We also have the China reopening that's going to be positive for global growth and some European exports, right? So it's a pretty mixed picture. The inflation picture is very clear, but the growth picture is not as negative as it was 4 or 5 months ago.
Jens, what does the positioning story look like coming into 23, and how's that changed over the last month alone?
Well, there's an incredible amount of focus on China reopening, and rightly so, right? But we can see in the last couple of sessions that some of these China reopening trades that are sort of looking a bit wobbly, even if the underlying data looks better. And then I think one thing is amazing is that the emerging market picture, actually, regardless of what the S&P does on a day-to-day basis, up or down, is trading quite resiliently. I think that's the evidence that this emerging market bull trade that is starting to kick in motion is potentially something that has legs. That's something that's not really been going for a multi-year period. If that starts to get going, that could be something that could go on for a sustained period of time. So I think positioning is light there.
Jens, can you tell me about why that could be a more durable story? Let's take a stock like Alibaba. Let's just throw that out. That's up by 76% from the lows of October. There's many people out there that say reopening story in China, it's happened over the last 3 months. Jens, what do you see that could make this a little bit more durable, away from the Alibabas of this world and to EM?
Yeah, so when we scan around the world, like we tend to look at China and then China X, like the other emerging markets like ex-China, right? And there we can see places like Mexico trades very resiliently, Brazil trades on its own, Eastern Europe trades on its own, right? So it's not all about China. There's clearly some China-linked trades like Korea, China itself, Taiwan. But emerging markets is a pretty diverse spectrum, and we've had more than a decade of bearish sentiment on EM, and we can finally see in the flows that investors are getting back into the EM trades, fixed income and equity globally, really for the first time in multiple years. And when we look at essentially the levels of exposure, they're still very low, right? So we can have positive momentum going on for a long time before the levels of exposure are concerning to us.
Jens, this was great. It's good to catch up. Jens Nordvik there of Exante Data on Europe, on the Fed, on the big global trade. It was Get Long International to start the year, and let's be clear, it delivered. And then, Tom, the Nasdaq rallied by about 9% for the month of January.
In the next 48 hours, I mean, where will we be Friday, let alone on Monday? And I think it'll be driven by the headlines in the news.
The payroll's coming up on Friday, the Federal Reserve coming up tomorrow, and a ton of data and earnings in between. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year. That's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The Eurozone is on track to avoid a recession. The region's economy unexpectedly grew by 0.1% in the final quarter, despite double-digit inflation in Russia's invasion of Ukraine. Output in Germany and Spain shrank, but French and Spain recorded expansions. President Biden says he won't send F-16 fighter jets to Ukraine. Military officials in Ukraine have been pushing for the fighters, saying they would give them an immense advantage on the battlefield. Ukraine's also asking for advanced missiles. UBS reported fourth quarter profit that beat expectations. The Swiss bank plans to buy back more than $5 billion of shares this year. Rising interest rates help UBS offset a slump in trading fees and transaction income at its wealth management business. And Asia's richest man, Gautam Adani, has completed his flagship company's $2.5 billion share sale. Investors had placed orders for about 100% of the total shares on offer before the end of the trading day in Mumbai. Adani Group stocks have tumbled since being hit with allegations of fraud by Hindenburg Research. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
We may have peaked on inflation, but it doesn't mean that the central banks will not further increase some rates, just to be sure. I do think that they are very clear in terms of what they want to achieve. They really want to get the structural inflation down. And that could come along with a real deceleration of economic growth.
Ralph Hammer's there, the UBS CEO, catching up with a good friend of ours, Manus Cranny. We'll catch up with Manus in just a moment. Let's touch base with the price action just briefly. In the equity market, equity futures negative 0.5% on the S&P to close out the month of January with a sizable gain on the S&P of something like 4.5%. On the Nasdaq, up by close to 9 percentage points over just 4 weeks and a little bit of extra trading days. Yields unchanged on a 10-year, 353.83 on a 10-year right now. Euro dollar 108.29. Spanish CPI yesterday came in hot. French CPI still elevated. Maria Tadeo told me German CPI was delayed. Lisa, why is German CPI delayed?
I can't explain that.
I was just shrugging my shoulders and just thought, what? Why?
But if you look at the prices paid index, which is some of the data that has come through for Germany, it's actually come in hotter than people had expected. So this is what we're seeing, the upside surprise on the heels of energy prices that are starting to climb upward once again. Does that start to matter?
Going into the ECB on Thursday, Tom, looking for 50 basis points after a punchy Christine Lagarde back in December. Do we get a repeat of the December meeting over at the ECB?
Mine's a nominal analysis. Do they have the nominal GDP to afford that confidence in monetary policy? Nobody really knows other than there's a war going on. But I do agree with Lisa that if you have a hydrocarbon rebound, that changes all of its mathematics for all.
The China story too. I think the IMF was pretty clear about that. Everyone's jumping on the headlines from the IMF this morning. Better projections, all of that good stuff. The China factor. There's so much we don't know, Tom, still about the China factor on both the demand side and, of course, what it means for inflation too.
Yeah, now, just to give you an idea how we look at this, folks, I was over my first glass of Tang here a couple hours ago, and I'm looking at 24-month period of 3.1 and 2.9 China guesstimate, which I believe averages out to 24 months of 3% growth. That's not good enough for the leadership in Beijing. They have to do better, and they'll do it by saving the real estate market.
Is Europe importing more inflation off the back of that growth?
That's the next worry. I mean, that's, Lisa she's in charge of that.
Of the what, chief worry officer?
Just worry.
Chief worry officer.
I'll just be over here. I don't know what's going to happen.
You just stay there and worry, okay?
Don't worry. I do it every day. Thanks.
Are we ready to go here?
I think we are, yeah. We're just waiting for you.
This is a joy. Manus Cranny is with us, who does Zurich like no one, and he knows that when it is about wealth management on the Bahnhofstrasse, it's about moving from UBS and 45 Bahnhofstrasse down to Hermes at 28A Bahnhofstrasse. I mean, Manus, this is about, there's the train going by. Manus, can you hear me? Oh, they're going the other way, too. Manus,
hi, Tom. I can hear you. Good morning.
Let me cut to the chase. Manus, is this a jump condition for UBS? Can they not be incremental, but can they really jump up given wealth management and the angst of Credit Suisse?
You try to dig into these numbers. There's a pretty big deposit into the Swiss bank at UBS, about $8 billion. It's darn hard to dig into whether there was this flow of money from just down there, Tom. You know Bahnhofstrasse a lot better than I do. I don't get to go into Hermes very much. And you walk up and you arrive here at UBS. So, look, I think that's a moderate distraction. The flow of money in times of angst is something time immemorial. $8 billion is not going to make or break UBS. There are a number of incremental things in the conversation with Hammers. One is the clients are still cautious. They're not convinced. I looked at Tesla, it went from 107 to 170. I said to a buddy before I went away, wow, risk on. He said, no, man. He said it went from 370 down to 105. This is not a risk on market. This is just nervous short coverage tapering, and the clients are not yet fully convinced. They're still in cautious mode.
Yeah.
Cautious clients do not deliver conviction, which is actual transactions in risk assets.
Manus, you're expert at this. What is the UBS distinction? I think we in America, it's a blended blur going back to Paine-Webber and all that. From where you sit, what's the UBS distinction versus other European banks?
They have synthesized investment banking to behave as the dog on the leash to feed wealth management. Probably investment bankers up and down at Bahnhofstrasse at UBS will come out and smack me. But what they have done in the past 12 years is they have created a machine that feeds the beast. The investment banking flow feeds the wealth management. Those products that are created within investment banking, they're so much more sophisticated than they were 12 years ago under the Armotti era, and that investment bank feeds into the wealth management. It's a dynamic shift. That's what Credit Suisse have to do. That is why the market cap of this puppy is $72 billion. The market cap of that thing down there, and I need to double check this, I think it's sub $15 billion. They need to reinvent themselves in the way that this bank has done.
Manus Cranny making friends at Credit Suisse this morning. Did you notice that, Tom?
Just a charm offensive.
They're going to have a great time.
Over there.
They're going to have a great time. Hey, Manus, thank you for that, buddy, as always. What happened to the nice shop we used to have by the river? Remember that? We used to stand by the river.
What Lisa and I remember when there was the Ferro junket.
That was for the S&B. And I tell you, every time I used to go over there, I'd always scratch my head afterwards. You'd have this really, really wealthy country. Everywhere you'd go, there'd be Mercedes blacked out, loads of people got loads of money, all that good stuff. And then you had the central bank freaking out about where the currency was because it wanted inflation high. I just never understood that. That sort of tunnel vision about getting inflation up and the currency weaker when the economy was so wealthy.
And Tyler Brûlé was just in. I believe, John, you were off on one of your sabbaticals, but he made Monocle, and he looked at a worldwide search of where to move. I know he looked at Helsinki, and he said Zurich. Tyler said, we're moving the shop to Zurich.
I understand your feeling. Why not just be happy, right? Be happy with the wealth that you have.
Sure, exactly.
Just enjoy yourself. Go skiing.
Beautiful country.
It's gorgeous. You guys all have perfect infrastructure. It is beautiful.
It's incredible.
They have so many gondolas
You know what we really
everywhere.
need? What we really needed was negative interest rates. That's what we really needed.
Well, now they're moving away from it.
To tie it into this week, I believe the Swiss National Bank has a modest holding of Apple. It's an odd lot of holding, but it's like 425 shares.
Think about how bizarro the last 10 years have been. The fact that they were building up a portfolio of US equities to weaken the currency domestically. And Tom, to your point, you could take any given tech name and you could go down the holdings on the Bloomberg and you'd see the Swiss National Bank on some of them.
I'm sorry, on our way to Davos next year, we can do a remote from Brasserie Lip.
Is that what you'd like to? Sense. Sure, we can do that.
There is a bigger suggestion here, though, of the asset price inflation over all of this time and this flight to quality and how the Swiss National Bank was the ultimate quality, which really suppressed inflation, created the wealth. It was just amazing flows. And they just didn't know what to do with the money, which really brings us to today. Are we going to drain that money, or is it still there, waiting to do something with it, given all of the asset price inflation?
I think in general, don't hit your mic stand.
I can't help it. I'm worrying.
She's fired up.
Sympathy mic stand.
She's fired up.
Good morning.
This is great for radio. Radio are going to love you for this.
Yes, thank you. I think that it's a unique experiment, but it comes to flows, and part of that will be, as you mentioned before, the inflation-disinflation dynamic with a rebounding China. That's about flows, and we haven't even talked about Japan and that unique soap opera.
Well, let's talk about Japan.
Where is yen?
Kuroda's got one more meeting to go on March 10th. Then he heads for the exit, and he leaves behind just a monster balance sheet, owning everything under the sun.
Yeah, it's important to me. Like, we can do our team coverage there in Tokyo on our way to the spring meetings of the IMF. But the bottom line is, at the IMF, they're going to be riveted on what the Bank of Japan does.
Could you share this diary with me? This diary you have about our schedule.
We can do it. The worst part,
I haven't seen it.
Help me in Washington. You can help me on this. I know Matt Shirley down there knows this. The worst part of Tokyo to Washington, and I've done it, is the last 30 miles from Dulles. It's the absolute worst.
Why is that?
It's just clumsy. It's JFK, is a certain agony, like you're stuck in traffic.
Sure, I know.
Dulles, you're not stuck in traffic like that, but it's clumsy.
At least LaGuardia's getting it done. You know, LaGuardia's really sorted out. That airport's gone from like the worst.
Well, this is called infrastructure
to one of the better
investment.
Did you see those fountains that change shapes?
Yeah, I've seen people video them. I'm just like, get a life,
I don't.
get your flight.
Okay, so you don't even look at it?
No, I walk past it. You have to see it.
One of the fountains, when it changes shape, it looks like Steve Cohen.
Live from New York. I'm so pleased the clock is done. This is Bloomberg. Where did the first month of the year go? Just like that, the final trading day of January. Blink of an eye, and what a rally we've seen over the last 4 weeks and change. Equity futures this morning, and good morning to you. Look a little something like this on the S&P. We're down by 0.5%. On the Nasdaq, down 0.75%. Biggest one-day loss on the Nasdaq of the year so far. Just yesterday, we add to those losses this morning. Still up, though, by around 8 to 9%. Quite a move over the last month or so. In the bond market, we started the year at about 442 on a 2-year. We came all the way back down to something like 423 very early on in the year, and then kind of stabilized over the last couple of weeks. On a 2-year at 423.83, on a 10-year at 353.64. Yields unchanged this morning. Just getting some numbers from GM. The numbers out just moments ago. Lisa, I know you've got an eye on them as well.
Yeah, right now we're seeing them beat expectations pretty much across the board, with 4-quarter adjusted earnings per share $2.12 versus a $1.67 estimate, talking about net sales coming in above expectations, revenue coming in pretty much in line. But this to me is going to be interesting, especially in light of the price war. What kind of guidance do they give at a time when you are seeing the likes of Ford follow Tesla cutting prices? Are they going to have to do the same thing to move some of their electric vehicles?
Okay, so let's imagine I want to go and buy a GM today. General Motors, whatever car it might be, some kind of EV vehicle, I don't know the brands, whatever. Let's say I'm going to make that call today. Why on earth would I do that today? Why on earth would I make that decision?
Because maybe GM is going to do what Ford does, which evidently, as Tom said, he broke the news to us that Ford said to them, we're going to cut prices, and if you bought recently, we'll pay you.
Am I going to take that
Tesla.
risk, though? Am I going to take that risk?
It's a good point. Are we creating a downward spiral with price pressure by consumers when they start to see that there is some sort of willingness to cut prices after so many years of price hikes?
Can I ask a dumb question? Isn't there a huge demand for these vehicles?
Oh, massive, yeah.
So they're cutting price even though or is there a dog EV vehicle they're trying to get rid of?
I was actually researching this last night, and
Stuart, why did we not know that? You and I are going.
Hold on a second.
Researching
this is interesting. The margins are so much fatter for the likes of Tesla than the likes of Ford and GM. They've got something like a 25% margin. So at what point do they just get greedy? At what point do they want to compete, particularly with Chinese EV makers and corner markets that are nascent and possibly have a lot of potential to grow?
We'll see if we get those cuts. We're catching up with the CFO a little bit later this morning. Exxon out with results as well for the 4th quarter, adjusted EPS 340. The estimate, Tom, 330. So we were looking for 330. We got 340. And the numbers from Big Oil over the last 12 months, Tom, pretty incredible.
Yeah, we're going to look at that too. We'll dive into big oil and the rest of it here, particularly off what we saw from Chevron. We take great pride, folks, in bringing you earnings away from the top 4 or 5 companies. We'll do that. Lisa really on top of what industrials are doing. This is an important interview for Global Wall Street, arguably our most important interview of the day, because he nailed it last time he was on about the lift here, a sense of optimism from Stuart Kaiser with Citigroup, head of U.S. equity trading, but far more than that, head of a derivative thought. What's the bet right now? In all the literature, Stuart Kaiser, it's okay. Kaiser was right, 6%, 7% bounce, up we go. But it's just short covering where people go, oops, I got it wrong. It springs up, but there's no oomph to break out. What say you about the idea of there is oomph to break out and move higher?
Good morning, Tom. And way too much credit, but thank you. Look, I think the year so far, if I had to describe it, would just be events that didn't play out, essentially, right? Like, you came into the year with very low expectations across the board from both macro results as well as single stock earnings. And frankly, that data just hasn't been negative enough to justify the low positioning we had coming into the year. So how do you keep moving higher? I think you get a continuation on Thursday in particular of large cap tech earnings coming through. And the Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with. And on Friday, we don't get an average hourly earnings number that scares us. And if those things happen, then I think the market can continue to move higher. But I still think you need to approach this very tactically, kind of like a month-by-month basis. This is not a, hey, I can be long for the next 3 to 6 months.
Filter and Citigroup's securities analysts who talk to you all the time about their revenue dynamic. If we get the disinflation that Citigroup and others are talking about, what does it do to the revenue line?
Yeah, I mean, look, that's the issue. I think that's been a big challenge for the bear case that earnings were going to get revised aggressively lower, is that you had positive revenue growth that kept earnings a little bit higher than expected. Obviously, if revenues start to ease, then we're really focused, as Lisa mentioned, on the margin story. And, so that's where the debate will kind of center, right? It won't be on top line EPS. It'll be on the quality of that EPS and whether investors are willing to pay a premium for quote unquote lower quality earnings. So it is an issue, but frankly, I think that's an issue we'd like to have, relative to where expectations have been.
We talk about recession as if it's an event, it's a process. And in that process, you start to get companies defending margins. And we've started to see that really at some of these big tech firms. Is that bullish enough for you, for some of these names, to have a durable tailwind through the rest of this year, to see them defending margins, to see them cutting costs in the way they are?
I think it is, and I think investors have kind of rewarded that to some extent. I think people are willing to look through a quarter or two of pressure. If a company can give them guidance that 2 to 4 quarters out, the margins are going to kind of normalize a little bit. And look, all this, again, I think is expectations driven. You had such low expectations for earnings and such a bearish view on where they could get to. I think even, by hook or by crook, if a company can produce the earnings, people are going to generally respond positive to it, at least tactically. I think, now that we're back above 4,000 on the S&P, the questions get a little bit harder, related to that. But yeah, I think if companies can show that they're making these cost cuts and that it's going to have, a visibility into where margins are going to get over the next couple of quarters, I think investors will respond positively to that.
The earnings haven't been great. People say that the resilience has been pretty widespread, better than expected kinds of results. They haven't been. They've been worse than expected at a higher pace than at any time going back to 2014, with the exception of March of 2020, those 3 months. So at what point do we look at the earnings and start to see maybe big tech is reckoning with some of the margin pressure, but the rest of the universe is facing it in a much more significant way that hasn't been fully priced in?
Look, I mean, all I would go back to, I guess, is price action on that. Coming into the week, we had about 250 large cap stocks we'd been tracking. 99 of those fell on earnings, 150 rose on earnings. So even though the earnings haven't been coming in great, the price action, I think, is telling you that expectations were washed out enough where it didn't take much. I think, sometimes if a company cuts numbers down to where the buy side is, that stock is then quote unquote clean, and people can kind of own it. So yeah, I think expectations, again, I hate to keep using that word, but I think that has a lot to do with it.
Do you think that there's a clean read on tech because of how much bad news there has been priced in, but on the rest of the industrial complex, it isn't so clean, with a lot of disappointments leading to some pretty big price action?
Yeah, look, I mean, stock by stock, we could certainly find some.
Tech, in some ways, poised to do better because of how much pain was priced in and how much of a house cleaning there's been.
That's our view. Frankly, is that early last year it was a valuation story on tech, right? The stocks were very expensive, rates and inflation were higher, and you got that huge valuation headwind. Third quarter earnings were a little bit different, where companies started to talk about cost cuts, pressure on earnings, things of that nature, and that's when I think expectations started to really ratchet lower for the tech space. Our view coming into this quarter was not necessarily that the results were going to be all that great. It's just that expectations were so low that it just put risk reward to the upside. Expectations were low, positioning were low. So in that sort of combination, it doesn't take a whole lot to get the stocks moving higher. So again, this could be a quote-unquote low-quality rally, which we think it's been. If you look at what's driven the rally, it hasn't been the best and the brightest. But we do think relative to expectations, that's where we sat. Again, I think you have to reevaluate that now that you enter February, because you're on a 4,000 handle after a rally. That's different than being at 38, 38.50 coming into the year, I think.
Well, we talk about this rally as if it's only been going on for a month. For the likes of Caterpillar, it's been going on since the end of September. That stock is up by more than 60% since then. They've just delivered earnings. Wow. The first earnings miss since the pandemic back in 2020. I keep hearing everyone talk about how do I want to play the China reopening story, and I keep going back to this. Well, it's been playing out for 3 months in the miners, in Caterpillar. Abroad, you've seen that. You've seen that story. In fact, for the banks over in Europe, it's been playing out since the summer. They have absolutely ripped. When you hear people say things like, how do I play the China reopening story? What are you telling them?
Well, I think you're right. It's gone in stages. I think at the beginning, a lot of people were using options to just get high payout, owning, let's say, the Chinese index, right? Then it became what you're describing as more of that infrastructure play. I think right now the question is how much of a consumer spending impulse can we get out of China as you fully reopen? And I think that started to focus people on things like, I don't know, luxury brands, in Europe. I think, German equities have really benefited from this as well because they have a lot of export exposure. So there's still a group of the investment community, I think, that isn't really comfortable owning China equity directly and outright, just given some of the policy challenges. So what people are looking for is what is that second order trade? And I think it was metals and mining and things like that. And then it evolved to just like a consumer spending or tourism story.
Jim Umpleby over at Caterpillar minces no words. In the near 100-year history of Caterpillar, last year was one of their best years ever. We have, on radio and TV, people stratified by this eco-Fed debate, all the uncertainties, and they're not in the market. How do they participate in Stuart Kaiser's optimism so they can possibly enjoy Caterpillar's near best year in 100 years?
Look, I think from an owning stocks perspective outright, as you know, we've been focused on more of these high quality stocks that you can kind of own through a recession. So that's, high quality stocks that are buying back a lot of their shares, don't have as much, downside earnings risk. So we've been sort of pointing people in that direction. And I think we're still of that view, Tom. It's most investors that I've spoken to, even though the market's rallied, they haven't really changed their baseline core positioning or portfolio, which still remains pretty defensive. So what they've been doing in this rally is using ETFs or options to just kind of add to their exposure around the edges. But I think when you sit down with them, they're not saying, oh, wow, we rallied for a month, my whole view has changed. It's more, yeah, I'm still conservative. I still want to sit in this portfolio. What I need to do is kind of risk manage around it. So I still think you're in this larger cap, higher quality, share buyback, type story, and then you're just trying to adjust risk around the edges. And we haven't touched on it. You also have a lot of folks that are saying, why do I need to be in equities? I can be in credit or I can be in bonds,
fixed income more broadly,
which is the second thing, yeah.
Wasn't it easier a month ago? Everyone just came on a show and said, sit out the front half. It's going to be ugly.
Yeah,
then we'll get this second half recovery.
Yeah, now it's...
In June, there's this line in the sand.
Yeah.
Then everything just starts rallying.
Yeah, and now you missed it, sorry. It's over.
Well,
it already happened.
That could be, actually.
It ripped.
Hey, Stuart, it's good to see you. Thank you, sir.
Thank you
Stuart
all.
Kaiser, a Citigroup, got into a big week ahead. I think I've said that for the 50th time already in the last 24 hours. The Federal Reserve coming up on Wednesday, so we'll have special coverage for you on Bloomberg Surveillance tomorrow afternoon. Then on to payrolls Friday, and in between, Tom, we are. And in between, we get some earnings and some data too.
Yeah, the earnings and the data are important. And somebody had a wonderful tweet out. The S&P 500 is at XPE. In the S&P 494, you take out 6 companies.
That was Alf. I think that, yeah.
Yeah.
I think it was Alf out on Twitter,
tweet
yeah.
to just show the courage someone like Kaiser has to be in the market is when you take out those companies. Many people would suggest it's fairly
I can't
cheap.
verify the numbers, but the theme is kind of nailed on, right? You take out the big players with the
well,
big
they're
PEs.
traded 17 times earning, Caterpillar, and they got to be a huge China play.
Cap right now down about 1.8%. Futures negative 0.4%. On China, Leland Miller, the co-founder and CEO of the China-based Book International. That's coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House will end a pair of COVID emergency declarations on May 11th. That will mean the end of the controversial Title 42, a policy that's expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. A new report says that Brexit is costing the British economy $124 billion a year. On the third anniversary of the split, an analysis by Bloomberg Economics says the effects span everything from business investment to the ability of companies to hire workers. The report estimates the UK economy is 4% smaller than it might have been. United Parcel Service forecasts sales below Wall Street estimates. The package courier is struggling with a drop in volume as shoppers return to stores. Meanwhile, inflation is cutting into spending habits. And Boeing will deliver its final 747 today. A cargo version of the jumbo jet will be turned over to Atlas Air. More than 1,500 747s were built over 5 decades. The plane could carry more than 500 passengers, and in Boeing words, it shrank the world and democratized air travel. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
If we're sitting here in 3-4 months and the U.S. Corporate sector hasn't broken, if the benefits of lower inflation is helping consumers, then the China reopening, which we think is largely going to be a demand impulse, is going to have an impact on commodity prices. It's going to have an impact on goods prices globally, and it's going to add a reflationary impulse to the U.S. as well as the global economy.
And that right there is the big risk from Bruce Kasman there, the chief economist at JP Morgan. Great to catch up with him in the last 24 hours or so. From New York City, equity futures look like this. On the S&P, we are negative 0.4%. Equities just a little softer, lighter, lower over the last couple of days, going into the Fed decision tomorrow. Payrolls on Friday, tons of earnings in between. Yields basically unchanged, Tom, 353.27.
Oh, it's going to be interesting to see all of that debate, and what it comes down to is a recovering global economy. You know, we're going to talk about China here, but John, I would go back to France, which is doom and gloom, war, things are terrible, and they gave us a positive statistic.
Over the last 3 months, yes. Can that continue? Do we have to relive the worries about next winter? Never mind this winter.
Yeah, we'll have to see. Right
That's
now,
the spirit.
Yeah, it's very Bramo. It's Edge of Bramo. Right now, we're going to look at China. This is an important conversation.
That's a valid point.
Leland Miller, are you guys done? Thank you. Leland Miller, co-founder and CEO of China Beige Book, with us right now, and truly excellent on the microdata of China. Leland, I'm confused. I've got Bloomberg Economics and a fabulous article out today. Really must read. I'll get it out on Twitter. Endicur and Sheng Shu, Bjorn Van Roy, who was just on the program. I butchered his name in the program as well, and Tom Orlick. And they're saying, forget about it. We're looking at 3-ish up to 5-ish GDP in China, and yet institutions have a much more cautious view on this, noodling around 3%. Who's right?
Well, I think this is one of the stories that's going to have to play out during the year. The China recovery is set up to be a very nice cyclical bounce back, but this could be a cyclical bounce back of a quarter or two, or it could be longer, depending on, one, whether consumers jump in, which is a huge if, and second, huge if, is if there's more policy support than, or I guess the policy support that people think. There's this assumption that the government is going to jump in and start stimulating on top of what's already an organic recovery. We're quite skeptical of that, but we're watching the indicators and trying to see where the government's head is on this.
My experience, Leland, is it always centers around a bailout of real estate. Let's call it healing real estate. Are they going to heal real estate with cash infusions from Beijing?
They're not going to heal real estate, but what they have been doing is culling the herd, and now they are going to ventilate the sector. So basically what they've been trying to do is take out the weak firms without killing the healthy firms, diminish property as a growth driver for China going forward. They've been doing that, but now you've got the potential for contagion because the numbers have been so unbelievably bad. Our December data, our Q4 data, some of the worst property results we've ever seen. So they're stepping in, they're providing credit lines, they're lowering mortgage rates. They want to make sure they give a little bit of oomph to the sector, but this is very different from the game changer it's being made out to be across the street. You got to be very cautious on what this actually means.
Leland, where is the money actually going? Where are consumers spending? Is it all domestic? Are more people getting on planes? Are you seeing those flows go into commodities to travel around, or is it going into staples and just activities in the region?
Well, it's too early to see the trends for the entire year because you had this first month skewed by COVID and skewed by the Lunar New Year holiday. This month, all the pops in the data were around where you'd expect, which is travel, restaurants, hospitality. People were traveling again. People were moving around again. And so you saw a big pop in that data. Going forward, the question is, are consumers going to come back? There's this assumption that Chinese consumers are going to revenge spend. They probably will a little bit, but the idea they're going to go do this and drive a recovery for the entire year. We've never seen anything like that. So again, we're going to watch the data because this is not the type of thesis we've ever seen play out before.
Where's the data? What's it pointing toward in terms of fossil fuel combustion, the idea of crude and natural gas, and what's going on with the coal imports from Australia? Some of the stockpiles, how depleted are they? How much is China going to have to import going forward?
Well, 2022 was awful. So there's going to be a lot of things going on, particularly early in 2023, which are going to lead to greater commodities demand. A lot of it has to do with how much policy support continues on through the year. Are we going to see them double down into some infrastructure and some other things? Because look, if you're talking about the consumer driving, the recovery this year, which again, we're quite skeptical of, but if you are, then you're not leading to huge tons of oil demand skyrocketing. You'll see it from jet fuel if there's more travel, but people are mixing their investment theses here because they're so bullish on the China recovery. But, that doesn't necessarily mean there's going to be a jump in oil demand throughout the year. So we have to be a little bit cautious on that.
I'll make a joke of it, Leland, because that's what we do on a Tuesday before Fed Day. But the joke is, does China do work from home? But really what it comes down to, are they back to work? I mean, with the advent of COVID, are people back to work in those manufacturing plants and all of the ancillary businesses to it? Are they back to work, and are they taking home a paycheck?
They're not back to work yet because, the COVID situation still hasn't calmed down. Maybe March they're back to work. Right now they're traveling they're either sick or they're traveling for Lunar New Year. So manufacturing hasn't, looked better. But we got to keep in mind, from a year ago level, it's way down. You can't see it when you look at the PMI because the PMI can't track data from year to year. But things have been up from the end of last year, but they're down on year. They're down from 2 years ago. So manufacturing is not seeing this superstar recovery just because the PMI had an upside surprise. Understand that manufacturing is not going to drive growth this year with a global economic recession potentially looming. It just happens to be one good month in the data.
Leland, how much are you watching what's happening in Washington and the sudden reprising of some of the animosity that U.S. politicians have toward China and the potential ban of exporting supplies to Huawei? How much is that factoring into your outlook for China for 2023?
Well, it's never gone away. I think people make too much of these meetings when Xi and Biden, shake hands, and Tony Blinken and Janet Yellen are going over to China, and a lot of people read into this saying, "Oh, the relationship must be getting much better." Well, it's good that tensions are calmed down in a short term, in a short period, during a short window. But this does not mean we're not heading in one direction in terms of tighter export controls and more tense policy back and forth. So this really hasn't changed our outlook at all. I think people have to understand that the relationship is going to get more fraught over time, not less fraught. And this is just another headwind between for the economies of both countries.
Leland, we've got a lot to talk about for the year ahead, that's for sure. Leland Miller there of the China Beige Book. The latest data out of Taiwan, the export orders for 2022. Lisa, that data was pretty ugly, to be fair.
Well, to be fair, a lot of it's because of the semiconductor cycle that we've seen and how you see that pretty widespread from all of the semiconductor manufacturers. They just have a glut of chips. That said, China needs the reliance on Taiwan. They need those chips. Everyone needs those chips in terms of some sort of national security reasons. So, again, how much is this a momentary cyclical blip versus something more substantial?
The year ahead is really difficult to call. The next 2 months is really difficult to call. You've got Neil Dutta of Renmac on the one side saying the Fed story only works if the economy is slowing down. Sorry, but I don't see it. On the other side, Steve Englander of Standard Chartered. And Tom, these are really bright people with completely different views on where the Fed is going to be come March. Never mind year end. Steve Englander talking about a pause at the March meeting.
That's the smartest summation I've heard in ages, John. That was dead on about the divide that's out there. And to me, where I go is sitting in the chair next to me are repeated people who are saying the path is down to under 4% inflation, dare I say under 3% inflation. No one has a framework right now of what 2.8 or 3.2% inflation means to our markets, to our lives, to our future, performance here across nations. I mean, forgetting about the war in Ukraine. I mean, no one's ready for that massive stochastic move lower in inflation.
Lisa and I talked about this yesterday. I think probably the most important line in the last couple of months was Sarah House of Wells Fargo when she talked about the final mile from 4% down to what? And do we get stuck there or not?
Well, it's just a set of different opinions wrapped around Dutta England or maybe his polarities. But, you know, it comes down to whichever inflation number you want to look at. Does it come down, as Liz Ann Saunders says, with housing being the dominant mystery for the American people? And it appears away from what we're living in New York. The three of us are completely biased. Is the fact is rents are coming in.
And does China confuse things all over again? Tom, can you really make a call on the global economy in the next 12 months?
No.
With a deep understanding of what China's reopening means for the inflation backdrop? I've got no idea.
Bloomberg Economics with Tom Orlick and all of his leadership, they're at 5% plus, and you got other people modeling out, no, 3%, as Leland says, they do better and then they pull back. I don't know.
Futures right now, down a third of 1%.
I think we need to research it.
On the S&P. You want to do some research now?
Yeah, when Hong Kong opens up, we need to go shake hand to currency.
Of course, Lisa.
Come on.
You're ahead of me on that
Obviously.
one. Of course. It's just another trip. It's another trip that we won't be doing.
Yeah.
On a 10-year, 353.46 from New York. This is Bloomberg.
There are opportunities for this rally to go longer and higher than you would expect.
It's not a strong growth picture. It's a grind, but I think it stays positive.
We're not as comfortable as I think the market is that the Fed has done here, that they will get inflation under control, that we will have a recession.
If we are going to see a recession sometime this year, I don't think that's priced into the S&P at all.
If the data continues to moderate and inflation continues to fall, that's your hike and pause in March scenario.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What time did Fed officials get out of bed, TK? Down in Washington.
Well, it's 8:30. Al Hunt always told me the wonderful.
You're going to troll them now?
No,
Day
just
starts at
They're not
8:30.
listening.
You know, get the kids
They're
off
not awake.
to school.
No, the vice chair tunes in at about 45 minutes. I know that. So you get to say whatever you want.
Until then.
Until
And then it doesn't
7:45 Eastern
happen.
time.
Yeah.
Live from New York City this morning. Good morning for our audience worldwide. The two-day Fed meeting begins, I assume, in the next couple of hours when they all get out of bed and get ready, Tom. Chairman Powell tomorrow in that news conference. TK on to payrolls on Friday. And then a ton of earnings this morning and going for the next couple of days.
Yeah, the summary of it here is margin dynamics. Margin dynamics for Apple and the rest, Amazon and their recovery story out of the pandemic, but also to watch wage dynamics out of the jobs report. And of course, this ECI report is important as well because that includes benefits.
And the data abroad as well. The Chinese data out a little bit earlier this morning. Lisa, upside surprise, reopening, the data rebounds, all the kind of stuff we expect, and the IMF playing catch up.
So what's priced in? That we have to keep asking that question. What has been priced in? You pointed out very smartly that we've seen this over the past 3 months. We've seen a rally kind of really gain steam in certain areas tied to the reopening trade. So have we priced in more momentum than there actually is? How do we even evaluate that? And to Tom, your point, what is the end Fed funds rate that we're talking about? What is the new normal when it comes to inflation to start expecting where we set these valuations? To me, that is really the key question.
Yeah, they're saying 5. And Tom, we've got people lining up to say maybe this hike tomorrow might be the last one.
Yeah, there's a set of opinions. And I'm sorry, it's data, and critically, it's data ex post. They have to wait to see. And in a fully employed America, and looking at McDonald's horrific numbers coming out right now, it's that McDonald's is trading 3% under a record high. Okay, 3% up, and they hit a record high. They've done 12.7% over the last 10 years per year. I mean, it's just terrible. I mean, they're just doing...
Just in case someone's listening and thinks that you're not being sarcastic, I'll share the numbers with our audience, shall I? Would you like me to do that? Yeah.
Please,
okay. Comp sales for the fourth quarter up 12.6%. The estimate plus 8%. EPS 259. Lisa, the estimate 244.
Came in much better than expected. And interestingly, sales came in better than expected, but so did earnings. Sales revenue came in much better than expected, whereas earnings per share, not as much, but still beating. Again, margin compression on the margins, but still sales are so strong that it really
they're up 29% per year from the bottom of the pandemic because we're never going in a McDonald's restaurant again. I mean, I'm there 4 times a week.
Stock is up 2.6%.
It's terrible.
You're just dripping with sarcasm.
I've said this. Come on. I've said this for 2 years. I want a victory lap here. Corporations adjust.
They adjust.
And that's what's going on.
They adapt.
Okay, fine.
Thank you. They adjust and adapt.
he gets extra pay to say adapt like that. It's just
This is a victory lap.
If we could clip that. Is that Tom's own victory lap?
Yeah, this is his
No, it's
victory
Tom's
lap.
victory
He just
lap.
said, give me a
Okay.
victory lap.
Come on.
Here it goes.
I'm
toast yourself.
sorry.
Have a
This
drink.
is McDonald's. It's terrible what they're doing. I think we should all have lunch there.
Stock is up
Take the whole
2.4%. You go celebrate, okay? The market looks like this morning. Good morning to you. Let's whip through it. Equity futures negative, down 1/3 on the S&P. Softer yesterday on the Nasdaq, biggest one-day loss of the year so far. Year to date, though, still up 8 or 9%. In the bond market, not doing much. 353 on a 10-year, euro dollar 108.35. Lisa, we're negative there, a little more than 1/10%.
Today's going to be really interesting. We've been really celebrating what's going to happen later in the week. But today at 8:30 a.m., we get the employment cost index for the fourth quarter. And we start to get a sense. Typically, this comes in a bit hotter than what we've seen on the wage increases. How much are we seeing a deceleration for how much the expenses for employees is going up year on year? And we're seeing that with the earnings that we keep getting. The costs are going up. Caterpillar eating into the margins there because of that. 9 a.m., we get a sense of housing data, including the S&P CoreLogic price data for the month of November. Here, the question is, how much pain have we already seen priced into the housing market, and how much do we see a plateauing? I mean, if you talk to economists right now, you're getting a sense perhaps the worst is in. And if that's the case, this doesn't really do much to ameliorate some of the inflationary pressures that the Fed would like to see abate. And we've been talking a lot about the earnings, and I think that the earnings probably are some of the most important data points. We get Snap, Electronic Arts, Advanced Micro Devices, and Western Digital all after the bell. But, John, as we've been talking about, we've gotten McDonald's, we've gotten Caterpillar, we've gotten GM, and it's not a clear picture coming out. You are seeing margin compression at Caterpillar, but GM's still crushing it. So how do you put this together?
You mentioned Snap is up 24% year to date. Meta's up
Year to date.
22% year to date, which is like 4 weeks, Tom, and a couple of days. Isn't
Yeah.
that crazy?
Well, yeah, but, even with EVs, Snap-on Tools is going to do great.
I'm not biting. And Angela Dyer joins us now, Global Equities Portfolio Manager at Invesco. You knew what I was talking about. And Angela, is this the real deal? And good to catch up with you. This rally we're seeing in some of these tech names, is this a real deal? Something you want to buy and hold?
So thanks for having me on, Jonathan. And good question, right? And the thing with bear market rallies, whether it's the real deal or not, is you really don't know except in hindsight. There's been a lot of data parsing done around this. But here's what I will say, right? The world is in a much better place today than it was 4 or 5 months ago. A lot of the apocalyptic scenarios have gone out the window. And simultaneously, on the other end, valuations have come in tremendously. And specifically with tech, I think we're looking at two very divergent buckets. One is the very good companies that have really good business models, high barriers to entry, are copious free cash flow machines. And there's obviously a lot of cyclical headwind. Customers aren't feeling so great. You have to work through estimates, etc. But arguably, some of these valuations are at a point where you're paid to take that risk. And then the other bucket of tech, which has been sort of, the biggest victim of the Fed raising interest rates because they've been long duration stories, that bucket is now painted as a, guilty till proven innocent. Rightfully so in many cases. They have to demonstrate that they can wean themselves off of the spigot of free money that we've enjoyed these past many years. But even then, there are probably some babies that have been thrown out with the bathwater.
I'm fascinated, at Princeton, the intimidation of sitting in a class with Alan Blinder. He wrote a brilliant essay in early January for the Wall Street Journal. And he said, what if inflation suddenly dropped? How does your world change if we get what Blinder's talking about and inflation suddenly drops?
Inflation is the thing. There's short-term inflation in the goods sector that's already started dropping, right? And I think what we're waiting to the point you were alluding to earlier, the shoe we're waiting to see drop is the tight labor market. So those are the short-term pieces that we think we'll see some leeway on anyway, and that's what the market's pricing in. But there's a longer view to be made, since we're talking academia, that there are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation, with the flick of the Fed's wand. The demographics are what's causing a tighter labor market. There's deglobalization, sort of the geopolitical harmony that led to all the globalization of the past 20 years seems to be dissipating. So I think we're underwriting to a base case of inflation not going back down to the lows it was immediately. And that's okay.
So what's the Invesco sum total return internationally? Are you looking at weak single digit, mid single digit? Can we be more enthusiastic and reach out to double digit returns?
At the index level, you had this conversation just Friday, I think, and it was fascinating, right? At the index level, nothing looks particularly spectacular, but below the index level, it's an entirely different story. We've had companies, since you mentioned Europe, that are bottleneck companies. They control an important bottleneck for massive amounts of global activity. They've been solid compounders for a long time and have structural trends in place that'll continue to let them do so. So on a stock-by-stock, bottoms-up basis, we see plenty of opportunities for very strong returns.
On an overall basis, though, how much of the trade for 2023 has already been put in, right? I mean, this is really the key question because everyone's been long Europe. Everyone has seemed to flood back to the tech stocks that were thrown out at the end of last year. Are we done with, and I don't want to say this because I'm going to get pilloried, but the easy gains, right? Is the easy money of 2023,
Is
gone?
it ever easy?
It's always easy. Let's go on. Let's move on. No, but seriously.
If you look stock by stock, which is what we do as active investors, not activists, the easy gains are not done because there are lots of companies trading at valuations where they're priced for the apocalypse, really. Europe, for example, 6 months ago, people thought they were going to run out of gas. Even companies that made medicines, right? They were pricing in a scenario where they would just have to stop. And obviously, a lot of that has unwound. You've seen that this quarter. But as you look at valuations and company positions, a lot of that is still left to come. Again, stock by stock, right? I'm not talking index level. And then the other thing about the Fed raising interest rates that's unheralded a little bit and unsung is it reduces competitive intensity. A lot of good companies have had these ankle biters in their sectors that have just benefited from free money and have slowed the pace of things. And we think a lot of companies are actually going to rebound structurally stronger from this.
Used to call them disruptors. Do you remember that, Tom? Disruptors. Disruption. That was like the buzzword for
You got to have 7
10
years of Princeton and Harvard to say ankle biters. And
ankle biters.
She's right. Absolutely dead on.
You're an ankle biter.
I am. I mean, it's a massive shift here to risk-free rate. I mean, frankly,
more ways than one.
People forget.
Total
people forget. This is important. People forget what it was like to have a real interest rate regime. It's affecting everybody at every moment within society.
There's still so many people, Tom, who think we're one rate cut away from boom. Back to tech leadership.
Yeah, I think I'm very curious of your belief that it's different this time for international, and that there's been so many failures of the international enthusiasm. Is it different this time because of the yield shift?
So what I will say is I take your point on the index level, but I'm talking about the below the index level where it's always been different, right? Some of the best performers of the past 5 years, even versus the NASDAQ, and maybe it's unfair just given what we've been through with the NASDAQ, have been international companies. There are companies in Europe especially, in healthcare, in semiconductors, etc., that have a stranglehold on economic activity in their sector, and they've just continued to get bigger and better, and it's been reflected in the share prices.
Ananya, this was great. Ananya Ladaya there of Invesco, thank you. Up next on the programme, we're going to talk to Norway's wealth fund, the head of that fund, Tom, and what a difficult
view.
time. Woof. So we were down 15% on stocks over there, 12% on bonds, and that was equal to $164 billion worth of losses, Tom, at a $1 trillion fund.
I saw the numbers for Norway, and I said, it's index performance. That's how... I thought they did pretty well versus people getting cratered.
Their mandate is to track the index.
Yeah.
Where do you hide if you're benchmarked?
And how do you move the needle?
That's going to have a really potentially.
Let's buy Denmark.
Situation.
That'll move the needle.
You trying to cause trouble?
No, I'm not. Of course
War.
not.
The CEO of Norway's wealth fund joins us next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year, and that's 0.2 percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The Eurozone is on track to avoid a recession. The region's economy unexpectedly grew by 0.1% in the final quarter, despite double-digit inflation and Russia's invasion of Ukraine. Output in Germany and Spain shrank, but France and Spain recorded expansions. The U.S. and South Korea plan to step up the scale of military exercises that have angered North Korea's Kim Jong-un. The drills have been scaled down or halted under former President Trump. In the past, North Korea responded to the drills with threats and weapons tests. Shares of ExxonMobil are falling. Full-year profit was a record $59.1 billion, and fourth-quarter earnings beat estimates. But revenue came up short. Plus, Exxon didn't announce additional share buybacks. The company kept its quarterly dividend at 91 cents per share. And earnings at Caterpillar missed estimates for the first time since 2020. Rising costs hurt the maker of the iconic yellow bulldozers. Caterpillar is seen as a bellwether for the broader economy since its machinery is key for the construction, mining, and energy sectors. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The worry is more with what we call core inflation that excludes energy and food prices that are typically more volatile. And these core inflation measures have shown more persistent, and they have not peaked yet in many countries, and they're still far away from central bank targets. So the job is not done.
That was the IMF chief economist. How many times will you hear that phrase over the next couple of days? The job is not done. From the ECB President Christine Lagarde, from Governor Bailey over at the Bank of England, or from Chair Powell for that matter over at the Federal Reserve, all three making decisions in the next 48 hours or so. The IMF sees a turning point in the global economy. The market's already seen that over the last 3 months or so. Looking at this market, what a rally to start the year. Equity futures right now on the S&P down 1/3%, still up over the last 4 weeks or so by more than 4% on the Nasdaq at the close yesterday. As of the close yesterday, Tom, up something like 8 to 9 percentage points. Year to date, it's been quite a run.
It's been quite a run, and it's a run wrapped around the mathematics of indices and the mathematics of what to do forward coming out of a pandemic. And if it's scope and scale, maybe no one has it like the Norway Sovereign Wealth Fund, the Norges Bank Investment Manager is with us right now, Nikolai Tango, when he speaks. All of Europe listens, and frankly, all of the global community listens as well. Nikolai, I think the headlines are wrong. They don't mention the scale that you have, where you lose 50 billion, 100 billion, 150 billion. Who's counting? They don't understand the mass. Given the size of investment you manage, how do you move the needle for 2023?
Well, first of all, we are a relatively index-near fund, so of course that's the main thing. We invest according to an index given to us by the ministry, but we also try to tweak out some excess performance, and that's what we did last year. We had more than 100 billion Norwegian kroner in excess returns, and that's what we work hard to do.
On sector basis, how do you move, given how tight your R-squared is to a given index that you look at? What micro decisions can you make to recover and maybe go in excess of an index return?
Well, what we did last year was that we were overweight the integrated energy companies, which did well. And we also were underweight recent IPOs because the market seemed really frothy in 21. And so we underweighted those, and a lot of those did really badly last year. So that saved us some money as well.
You talk about being defensive in 2023. What does that mean, Nikolai?
Well, I think 2023 is much more difficult to call. You know, coming into 22, we had a more of a careful stance. There's less of these extreme situations to look at now going into 23. So we are more equal weight generally. It's a very tough market to call.
Is there a lot of pressure within Norway to shift the mandate away from being so closely tied to the index, so subject to the flows of the macro world, to move into private assets, whether it's private equity or real estate, and expand that bucket that you already have?
No, I think it's very, very important for a very large fund like this to be quite index near, because the thing is that if you are too far away from the index and you make big mistakes, the losses are going to be so big that nobody's ever going to keep the job. So it needs to be index near. It needs to be anchored with politicians and in the parliament.
So what are you expecting? What are you preparing the residents of Norway for in 2023 in terms of returns if you don't feel very confident that you can get back what you lost last year?
I think it's important to make sure that everybody understands that we will not have a repeat of the last 25 years. We had a period where rates were coming down, where globalization was going really well, and we are now in a very different situation. You're seeing a reversal of the globalization. You're seeing rates having moved up, and it's of course very unclear where they're going from here. So returns going forward will be different.
Nicola, I'm really honored to ask this question, given your hedge fund expertise and moving on to serving Norway with the huge challenges of jillions of dollars of money, your philanthropy, etc. What do you think of America's fixation on windfall profit taxes? Does American hydrocarbons need to be more like what I read about in European hydrocarbons? What do you think of a windfall profits tax?
You know what? The one thing I have learned in this job is I'm not supposed to have any political views whatsoever. And so I think I will pass that question on to somebody cleverer than myself.
See how he's pro.
Yeah.
I mean,
he's very media trained, Tom.
He's very media.
You don't touch
he's
that one.
Savvy. He didn't touch that one at all. Then I'm going to look, Nikolai, at what we do forward here if it's just an index fund and participate. I want you to talk to our people who have not participated in the bounce up in January. They're scared. We make a joke here, Nikolai, about the triple leveraged all cash fund. How do people scared stiff participate at an index return level?
I think the very big question this year, the $1 trillion question is what will happen to global inflation when China really comes back on stream, when they start to consume the way they have done in the past and so on. Will that drive raw material prices, and will that impact inflation in the rest of the world, so that the tightening will continue and perhaps even accelerate? Because that is the biggest risk to equity markets. The market does not expect that, and if that happens, we will have a big leg down.
There's a question about simplification and whether it's a time to simplify. Nikolai, I know that the Norwegian Sovereign Wealth Fund is talking about reducing significantly the number of companies that it's investing in. Why is that important? Why is that simplicity a main goal of you?
Well, I think it's really important because for the moment we own 9,000 companies around the world. We own roughly 1.5% of all the companies in the world, but 9,000 companies. And the one thing you can be absolutely sure about when you own 9,000 companies, if something goes wrong anywhere in the world, you own it. So to go from 9,000 to 6,000, I think it's just going to be great. It got minimal effect on diversification, minimal effect on returns, but just reduces complexity in the whole organization.
Nicola, I wanted to finish on, I think, the major question for you guys, and you touched on the heart of the big risk for 2023. That's inflation and the potential that inflation is sticky, because the big losses last year weren't just that equities were down, it was that bonds were down too. Nikolai, do you have any degree of confidence that this year the more intuitive relationship between bonds and equities reestablishes itself?
Well, it's certainly more likely to reestablish it when rates are higher. We came into last year with a return on the bond portfolio of 1%. We ended at 4.1%. So that normal relationship is much more likely to hold this year than it was last year.
Is sticky inflation a threat to that?
Yes, it is. I do think sticky inflation is one of the big threats we have here. Having said that, it's certainly a known unknown. And the thing that really spooks the market is always the stuff you never expected. The financial crisis, the meltdown of the nuclear situation in Japan, or the COVID, the kind of things that you've never seen before, where it really causes a lot of fear. That's the real risk.
Is there one you're discussing around a table right now that you don't think people are talking about enough?
No, I think the really scary stuff is the thing you haven't even thought about.
Nikolai Tangen of Norges Bank Investment Management. Thank you, sir. That was just for Bramo at the end there, TK.
It was.
Sticky inflation, though, for many people. Andrew Ball said this last week over at PIMCO.
That's good.
The fact of the matter is, if we stay at about 4 to 5, you've got a problem. And the thing that's haunted many of these guys is that we've got losses on equities and on bonds for pretty much every single asset manager across the board.
Unique back to 74, and I've seen some people take the bond debacle back to 1788 or something as well. I think, not to be critical, but on a relative basis, it's underplayed how well Norway did last year. I mean, is it a home run? No.
On the bond side or the equity side?
Both, frankly. I think on the bond side they maybe did better than indices, but for them to perform and come in negative 14, look at everybody else's portfolio.
He's made the point a few times. They own almost everything. The big decision for them, Lisa, is what not to own.
Exactly, and they're going to try to cut some of that potential risk that they might not know in some of those companies of the more than 9,000 they currently own.
Norway's sovereign wealth fund, losses equal to $164 billion. The fund now $1.3 trillion. Coming up, Mike Schumacher, the global head of macro strategy over at Wells Fargo. We'll talk the bond market, the Federal Reserve, the ECB and the BOE, all coming up, going into payrolls on Friday. That's next. This is Bloomberg. The week begins tomorrow. The Federal Reserve decision just around the corner. Going into it, the two-day meeting for the Federal Reserve begins a little bit later this morning. Going into that, equity futures a bit softer. Equities yesterday a whole lot lower. On the S&P, we're down 0.25% this morning. On the Nasdaq 100, negative 0.4%. Tons of earnings. Lisa will get to that in just a moment. Here's the shape of the bond market for you: 2s, 10s, and 30s. Over the last couple of weeks, I have to say, really stable on a 10-year, on a 2-year, on a 10-year, in and around 350. Right now, yields lower by basis point, 352.35. The 2-year in and around 420 for much of the last several weeks. Yields unchanged at the front end, 423. Want to finish on euro dollar going into the ECB on Thursday, looking for a 50 basis point hike. Euro dollar 108.38. In at around 108, 109, with inflation in Spain coming in hot, still elevated in France. And TK, seemingly the ECB just ready to go 50 again and maybe even teeing it up again and again.
It's the parlor game, and it's played out over there differently than here. I think England's being ignored now. I don't know if there's a parlor game in Japan, but they're going to blink here, as you mentioned, in March or April. And it's just great uncertainty waiting for data. What's the data that matters? Without question, it's wage inflation.
For Governor Kuroda, Tom, for the BOJ, you mentioned it, his last meeting in March. If you were taking over from the BOJ, quickly, what would your preference be? Would you prefer that the previous governor just set policy on a new path, or handed over the mess of that balance sheet?
My preference would be to listen to the political landscape in Japan as they confront for the first time in generations tangible inflation, far more than anything we're feeling.
Lisa, all of that coming up in the next month or so.
Right now, though, we do have earnings, and we've had earnings throughout the morning and throughout the week and throughout last week, and I find these earnings completely fascinating. I got to be honest. Pfizer came out, and I know we don't really talk about the pharmaceutical sector that much, but what I find interesting is that revenues are going down so significantly for COVID-related vaccines, COVID-related remedies. This, to me, really raises a question of what risk we have going forward if people aren't getting their different boosters. And we can get into all the controversy around the bivalent, the covalent, the trivalent, and whatever else. But either way, aside of the Times, those shares lower by 3% ahead of the open. UPS shares, interestingly, up about 2%. Basically, this is a story of steady margins. This is a story of cost cutting. Their actual revenues came in just a touch lower than the street expected. However, they are doing cost cutting enough to bring their operating profit margin up beyond the expectations. How much is this going to be really the story of the winners of this year? And McDonald's shares lower by 2%, which is kind of interesting because they beat expectations across the board, both on revenues and earnings. And yet those shares have underperformed pretty significantly. How much, again, though, is this what has been priced in? Because last year, McDonald's was a massive outperformer. It was only down, about 1.5% versus the overall pretty massive declines that we've seen. Those shares at $265.32. And I just want to end on GM because we are going to be speaking with the chief financial officer in just a moment here, Paul Jacobson, about what they delivered. Those shares surging almost 5% after delivering beats across the board. Now the question is, what's the backdrop in terms of price cuts and the price wars that we've seen so far?
Can I get a cheaper Hummer?
You strike me as a Hummer person.
Yeah.
Yeah.
Can I get a cheaper Hummer?
Is that your goal?
No. Who drives a Hummer, Tom? You know someone who drives
John
a Hummer.
Tucker.
John Tucker does, doesn't he?
No, he does. It's been
in radio. Did
he
you
had
know
it in
this?
the garage for a while.
No, John.
He really does.
He has a
no,
Hummer.
at $5 a gallon, I believe he put it in the garage.
Did he?
Yeah, I think.
He stopped driving it now.
Yeah, for like 3-4 months, but I think he's.
Did you not know this?
No, is it electric?
Well, he lives on the beach.
No, I think if he's looking.
Loves it.
I don't think he can get one. Even he's with Bloomberg Radio. John Tucker is so magnificent. He can probably get in front of the line, but he hasn't.
That's going to be the first question.
Yeah.
Do we get price cuts? Busy week for central banks, not just for auto dealers. The Federal Reserve leaving investors bracing for a downshift. Mike Schumacher of Wells Fargo saying the following: our bias is to expect risk to be tilted towards higher rates and a stronger dollar around the Fed announcement. Tom, any hawkish comment from Powell along the lines of "we will keep rates high for an extended period" might be met with indifference from markets unless next week's ECI data surprise meaningfully to the upside. We get that data, Tom, a little bit later. That's going to be important.
It is. This is important. I'm a big believer in ECI data because it folds in wages and benefits. It's got some real sophistication to it, maybe compared to average hourly earnings. Mr. Schumacher joins us now with Wells Fargo, Global Head of Macro Strategy. I'm going to look, Michael, here, ECI data, and maybe that's what brings a 10-year out of its doldrums. The doldrums, you think, folks, of the equator in boats of centuries ago staying flat in the water, and that sure feels like the 10-year yield right now, or the real yield as well. Where's the real yield in a year? I need an actual Wells Fargo bet.
Real yield in a year on 10s, Tom, 150 to 175, something like that. It's been having a tough time getting sustainably above 1.25, sort of stuck in the doldrums, as you mentioned. But at least in our view, the Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while. So 150 plus at the end of the year.
My study of that is normal ages ago was 2% or maybe 2.05%. I'll let you, as the pro, give me a better number. What are the ramifications if in this cycle the real yield only gets halfway there? I mean, it's just not going to go out to the fear levels people are talking about.
I agree. Going back 20 plus years, let's say, 2% plus on reals was pretty typical, made a lot of sense, whether in Fed funds, whether in 10s. But you still have central banks so active in the bond market. Yes, I get it. The Fed's cutting back, et cetera. But nonetheless, the Fed and other central banks own so many bonds. They've really distorted that relationship and brought yields down. And it's basically a secular decline. So pushing reals up to 150, maybe 175. Historically, it's still somewhat low. But versus the last few cycles, pretty tight and much tighter the last time around.
Mike, what's going to push 10-year yields higher?
I think a couple things, Lisa. One is actual rate hikes out of the Fed. The Fed will do the usual stuff. Powell's going to talk about, yes, we're not going to switch quickly into easy mode, but the market's heard that time and time again, very consistently since Jackson Hole, tunes that out. But you get a rate hike this week, a rate hike in March. People start to say, the Fed's actually serious about pushing rates up a little bit more. And oh, by the way, it's not so likely to switch into easy mode. And I think having the economy, we saw this with GDP, not roll over quickly, gives a bit more of a boost. So it's those things. It's really more Fed tangible activity, tangible rate hikes, combined with economic data that show a bit of weakness, but not a real collapse anytime soon.
So here's the conundrum for people who typically looked at weakness in the economy as a reason to pile into bonds, not exit them. Are we moving into a scenario where it's the opposite on an ongoing basis, where people basically move away from bonds in the sign of weakness, even though that could mean recession, that could mean lower inflation, and it could mean a haven trade is back on?
I think it boils down to the inflation call, and it was an interesting question you posed to the last guest from Norway. Do the correlations normalize going forward? At least in our view, if inflation stays high, you probably get correlations that are still very much out of whack. But if inflation were to drop down a bit, then I think you get people really reasserting that typical relationship with bonds being a safe haven if equities suffer. But until that happens, not so much. So I think it's probably a couple months out from really making a good judgment on that.
What will you listen for in the press conference? I'm already looking out here. I've got to look it up, folks. I'm sorry. I don't have the dates mentioned. March 22 and May 3rd. How will you listen to the press conference tomorrow, Michael Schumacher, trying to frame out the guesstimates of the next two meetings?
If by some odd chance Powell actually is specific in terms of framing potential rate moves in March, that's going to be huge for sure. But I suspect, Tom, we're not going to get that much out of the press conference. From our perspective, frankly, the more interesting meeting this week is the ECB, because the market is so teed up for a hawkish response. And the ECB has been very clear it's going 50, not this time, but potentially going forward. And we're actually skeptical about that. We think that's unlikely. So I think the more interesting action is going to be ECB day, less on the Fed day.
X the war and the daily trauma of those headlines, does Europe have the oomph to enjoy a higher rate regime?
Not really. So if you think about the European economy over the last, call it 10, 15 years, it's been characterized by very, very low growth. Italy's had no growth in 20 years. Does that automatically switch if the war ends? No. So does Europe somehow figure out a way to get out of this low growth environment? I doubt it. And that would tell us that ignoring everything else, you would expect policy rates to be higher in the US, and probably the UK, than continental Europe. But it's going to be a while until that happens. So the immediate concern from the ECB is, what do we do about this inflation thing that we've ignored for a long time? Now we have to fight it. And by the way, the ECB's mandate is headline inflation, so it's got more volatility. But as far as long term, no, the European economy will not grow like the US or most others for that matter.
Mike, I want to issue a mea culpa. Earlier in the show, Tom told me that I skipped the lead, that I buried the lead when it talked about the IMF and what they came out with, that they really just really shunned the United Kingdom and how difficult that situation is. Why do you hate also on the pound and what's going to happen there in that economy?
Yeah, frankly, Lisa, when you look at the UK, it's got so many difficulties right now. So inflation, yes, we know that story. The war, sure, we get that. Commodity prices, tough. On top of that, you've got the Brexit hangover. Don't have trade agreements with the US and many other countries. So in many, many dimensions, the UK has got a huge political problem. And the Bank of England is looking at it and saying, what do we do? We're not really sure what the inflation path is, nor is any central banker. In addition to that, we've got this very funky political response. So I'd say the most likely course of action for the BOE, it hikes a bit more and stops and waits. So the path there is just much more convoluted than for other central banks.
Technical term, that one, Tom. Funky. Funky political
Yes, in
situation.
Paris it's funky.
Do you like that? Mike, thank you. We're going to let you go. Mike Schumacher of Wells Fargo. Ending on the UK there. Can I pick up on the United States? The IMF has got a forecast now for 2023 GDP growth for America of 1.4%. The Federal Reserve has a forecast of 0.5%. I'm very happy you brought up the March meeting, because in the March meeting we get new projections, and I wonder what those projections are going to look like for both growth and on inflation.
We'll look at the data.
And that really is going to be the tool to push back against market pricing for rate cuts. So the meeting in March, Tom, I think more significant for a lot of people.
And huge data significance here. And, you know, we got a whole set of data here, 2-3 days out. But then, inflation data into February is critical. And I'm going to go back to the great Liz Ann Saunders, who said the mystery for her is housing. Can you imagine if you actually get housing disinflation? I mean, no
or if you
one's
get a
prepared for
re-acceleration and a pickup, Lisa, because rates have backed off.
Well, but that's exactly the problem, or the gain if you own housing and are invested in it. But there still is plenty of money looking to buy stuff, looking to take advantage of that. And we hear that every day.
March 22nd, where are jobless claims on March 22nd?
Yeah.
Right now, 186,000. Are we still in and around 200K by the time we get to March? In that case, this Fed
has to keep going.
You'd imagine it keeps going, Tom, if it's worried about the outcomes and consequences of a tight labour
What
market.
I'm hearing consistently is it's a fully employed America. That's what I'm hearing.
Interesting conversation coming up next. Paul Jacobson, the CFO of General Motors. Earnings this morning, pretty decent. The stock flying. And a big question for many of us, where are the price cuts? That's next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House will end a pair of COVID emergency declarations on May 11th. That will mean the end of the controversial Title 42, a policy that expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. In China, manufacturing and services expanded for the first time in 4 months. The country's reopening from COVID-0 continued, and the Lunar New Year holiday spurred travel and spending. It's welcome news for the global economy, which is cooling and will rely on China's recovery to offset other risks. Brazil's former president Jair Bolsonaro is in no rush to leave Florida. Instead, Bloomberg's learned he's applied for a 6-month visitor's visa. That's making life uncomfortable for the White House, which will welcome Bolsonaro's successor and bitter rival Luiz Inácio Lula da Silva next month. General Motors expects its earnings momentum to grow this year. The automaker reported better than expected profit in the fourth quarter. GM is counting on continued demand for its highest profit margin SUVs and trucks. It's also expecting higher production levels as supply chain issues fade. And Spotify reported fourth quarter subscriber growth that beat estimates. Gross margin also was better than expected. And ad-supported revenue at the music streaming giant climbed 14% at a time when brands have slowed down their spending. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
General, when it comes to semiconductors, we see the challenges of the last years ease, so supply is clearly picking up. In general, we see costs coming down, maybe not to normal levels. Also, energy costs, of course, still higher than a couple of years ago. But overall, we see the cost pressure coming back from the challenges we've seen maybe half a year ago.
Martin Sander there, the general manager of the Ford Model E. A big question in the last couple of days. Are we going to have an EV price war in the United States of America? We'll pick up on that theme in just a moment. Equity futures right now negative on the S&P, down by 0.2%. Yields coming a couple of basis points on a 10-year, 351.79. A bit of economic data coming out a little bit later this morning. Tom, going into the Federal Reserve tomorrow and payrolls on Friday.
It's going to be interesting to see, John. And, you look at the way the futures are in the data here today, and this ECI, which does hearken to General Motors, John, is about the combined wage pressures of wages and benefits
that
as
word
well.
Sticky.
Yeah.
How sticky is that story going to be?
Yeah, it's going to be interesting to see the less. What we're going to do right now is talk to a C-class officer of a different cloth. He's out of Auburn and Vanderbilt, but very different. He's the only one in the automobile industry that tried to go to a quieter industry. He was at Delta Airlines for years, and the volatility of everything aviation. Paul Jacobson is the chief financial officer of General Motors, and Lisa's going to grill him on her need for an electric car. You need a GM electric car.
I'll let someone else do the sales pitch, but Paul, I am curious, starting with the airline industry and the price wars of yore, are we entering into a new price war of the electric vehicle ilk?
Well, first of all, Lisa, Tom, thank you for having me on. And Tom, I wore my Auburn tie today just for you. But I just want to say thanks to the GM team for everything that they did, overcoming tremendous levels of adversity, huge inflation results, over $5 billion of inflation to deliver the results that we saw in 2022. And, vehicle demand for our vehicles remains quite strong for our EVs and for our ICE portfolio as well. So, as we look at the business, competition is no stranger to us. We've been in the business for over 100 years, and I think the team is really, really good at competing. And where we see consumer demand for our vehicles at our price points is really strong. We just need to make sure we get production up to be able to meet that demand.
So you're saying basically you're not going to cut prices because you don't need to. People still are really requiring your cars regardless of what the price is.
Yeah, we have waiting lists for all of our vehicles as we roll out, and we expect production to ramp up pretty quickly as we get, especially into the back half of 23, to meet our goal of delivering 400,000 EVs by the first half of 2024 and 1 million EVs annually by 2025. We believe the demand is there and strong.
So how does this really pair with the story that we're seeing out of auto sales, with sagging sales, one of the worst years last year, going back in a number of decades as a whole, and people are talking about demand waning on the margins? Why is GM seeing such a different picture?
Well, I think, a couple of things. One, the quality of our launches and the new vehicles that we've brought to market are really being received well by our consumers. I think our engineering and manufacturing teams, partnered with our supply chain teams, did a great job of increasing production last year by 25% over 2021. And we've been seeing vehicles move very, very quickly once we get them to dealers. We have seen some challenges in the outbound logistics. So this is after we finish a vehicle and getting it to the dealers. That's caused our inventories to increase a little bit. We're up to about 50 days of inventory. But if you look at the vehicles that are on the lots at dealers, they're about a third of what they were in 2019. Some of that is going to be, I think, permanent synergies, but some of that just speaks to how quickly vehicles are turning when they get delivered to dealerships. And that's a testament to the quality of the products we produce.
Paul, the aviation business that you were part of had a big turnaround around where they started to be responsible about free cash flow, responsible to shareholders. We lost the volatility, the huge volatility, the craziness of aviation pricing. The fact is the automakers trade at single-digit price-to-earning multiples. You can use every other metric you have. Is there any pressure in the boardroom of GM to get a more persistent free cash flow that earns a higher PE multiple by the street?
Well, thanks for that question, Tom, and thanks for highlighting kind of some of the work that we had done back in the airline industry. And what I would tell you is we spend a lot of time with the board on free cash flow in particular. Cash from operations and the cash generation of the business is what's funding our journey, and we've been very clear about that. So a strong ICE portfolio and a strong vehicle portfolio through the transformation is critically important to us. And there's a lot of things I'm proud of the GM team for what they've done, but when you look at free cash flow generation on the backs of near record capital investment in 2022, I think it speaks to the focus that we have. $10.5 billion last year. We think we're going to generate another $5 to $7 billion in free cash flow in 2023, and that's with a couple $1 billion increase in capital expenditures at $11 to $13 billion this year.
I don't want you to be Apple here reporting on Thursday, but are you at a point where you can take use of cash and reward shareholders to garner a higher price to earnings multiple versus the ancient, back to Mr. Sloan, of piling it back into the business?
So we have a very balanced and prescribed capital allocation process, Tom. So, the first thing that we're doing is investing in the business, and we have a lot of transformation work to do, as you can see from the capital that we've put in. But as we start ramping up EV volumes, as you start to see production of our Ultium cells at Cell Plant 1 and then Cell Plants 2 and 3 coming online, you're starting to see the benefit of that, because I think we're going to be incredibly well positioned for the growth in the EV market. But once we've invested in the business, we also have to make sure we maintain a strong investment-grade balance sheet. And at the end of the year and even early this year, we've early redeemed some bonds with that cash flow to help strengthen the balance sheet and fortify that. And we also, in the back half of the year, returned $2.5 billion back to shareholders. I think it's important to strike that balance because what we invest has to earn a return on invested capital, but our shareholders and our bondholders have to see tangible results from that. And, I hope to see more consistency in that across the board.
Paul, just to wrap up, we've been talking a lot about how the pressures between the fissure between the U.S. and China are really creating some headaches in the C-suite. From your perspective, are you looking to reduce GM's dependency both on infrastructure, on supply chains coming from China, as well as sales into that nation?
Well, first of all, our China team has done a remarkable job. They had a lot of challenges in 2022 with the zero COVID policies, and we're obviously seeing, a lot of some COVID slowdowns in late 22 and into 2023. But the team is really focused on that. We've got strong partnerships there. We've got strong GM vehicles coming to that market as well, and I think it'll remain an important piece of it. That being said, with the deal that we announced today with Lithium Americas and with work that we've done with Controlled Thermal Resources and Livent in the lithium space and POSCO and others, you see a much more geographically diverse supply chain building for some of those battery raw materials, and we're gonna be able to take advantage of that, I think, because of our size and scale and our willingness to work creatively with our partners.
Hey, Paul, great to catch up. Stock's up this morning by 4.7%.
Just because of Paul. Mary had nothing to do with it.
That was it. It was just that conversation, that 5 minutes. That's all that matters. Never mind 3 months of work. Just that.
That was a really responsible, but I think you really see the share usage there, the cash usage rather, where he mentions $2 billion returned to shareholders, which is like a rounding error for UPS or for, name the other country. And I'm going to look here, folks, and this is the separation financially. Price to earnings ratio out to the end of this year. Bloomberg models GM, it's 6.37, and a small electric car upstart at 39.79. I mean, this is bizarre math.
That's been a story for a while, though, hasn't it, Tom?
Oh yeah, but I just growing up in Autoland, I was on the eastern edge of Autoland, is how I would put it. Rochester carburetor, I can't remember exactly. Anyways, the bottom line is they've always got an excuse to reinvest in new product. Where everybody else is going, what are we going to do with the shareholders? I just don't get it.
Just to be clear here, no price cuts. Was that the takeaway from that?
That's the takeaway. No price cuts. People are still buying the cars that they have at the prices that they have.
We mentioned that earlier.
Well, no, we asked about it, right?
And he basically.
Oh yeah, he's a little more informed than we are, to say the least.
Mike Bell's coming up next from JP Morgan. You think? Equity futures on the S&P look like this: negative about 0.1%. A move off the lows in the last hour or so. Yields lower by 2 basis points. Your 10-year 351.61 from New York City. This is Bloomberg Surveillance.
I'm not convinced that we're going to see inflation get anywhere near target as soon as the market would like.
We need wages to come down pretty significantly, and I'm just not sure that's going to happen.
If you look at the labor markets alone, yes, I think it's easy to conclude there's still upside risk to the Fed's path.
It's going to be a Fed that continues to talk about the need to do more.
The data is going to look encouraging, and the data on the road to a soft landing doesn't look very different than the data on the road to recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene together again in the 8 o'clock hour, an important hour of data here on radio, on television. And John, it's simple. Everybody in our opening says data matters. We all know it matters for Chairman Powell tomorrow. And in this half hour, we see key labor data.
It's funny, Tom, if you ask guests this week what they'd be more interested in, Fed Chair Jay Powell in that news conference or the economic data this week, spoken to a lot of people who say the latter, not the former. They want to see the data. And that makes it very interesting when it comes to this debate about rate cuts or not. Chairman Powell can say what he likes. That argument will be settled. That debate will be settled
by the data. Absolutely. Data. Totally agreeing. On the ECI on radio, this really works where we get the handout where ECI data is like 0.95% as a moving average. We go down, some wage disinflation spike up with the pandemic, and we've come down 2 data points. And John, the persistency here of a new data point down again will be critical.
Once we get through the ECI, then we've got the ISM tomorrow. ISM manufacturing.
First of the month.
Sub 50.
Yep.
And that's the push-pull, the real tug of war right now. The survey data, the soft data, the ISMs, the PMIs are sub 50. And on the other side, I think the real test for the bear case at the moment just seems to be jobless claims, 186,000. That is like the test. If you ask any bear on the economy, yes, you hate the economy. Okay, please explain why jobless claims are 186,000. They struggle to do that.
3 days in a row. We're not going to do a brief this hour, but Lisa, it's real simple. We've got Feds tomorrow, then critical earnings from big tech. I guess they haven't disappointed so far, even with the pullback we've seen in the last 2 days. And then Jobs Day on Friday. It's nonstop here from 8:30 this morning.
The big question mark that might get answered a little bit is the consumer, because on one side, on the industrial side, the manufacturing side, you have seen a contraction. On the services side, you have as well, but not as much. And there was a Citigroup report that came out overnight that talked about credit card transactions in January. So the consumers keep spending in a massive way. They're seeing gas prices are coming down. That's giving them more discretionary spending. You see all of a sudden mortgage rates coming down. Suddenly people are going back into housing. That resilience still there.
And John, this is critical. And you mentioned the polarity of 2 of our guests here on economy, half glass full, half empty, the whole thing. Neil Dutt is suggesting with that disinflation, real incomes sustain, and that helps the consumer.
He sees a buoyant economy. He thinks this economy can pick back up. On the other side, Tom, is Steve Englander of Stand Chart saying we can pause at the Fed in March. He doesn't think we've got the data right now to make that call for Chairman Powell on Wednesday, but ultimately he thinks by the time we get to March, we will have that weak data in hand. Now, I remember that argument being made about the month of September. September 4-5 months ago. We were talking about September and the weakness that you would see that would be unavoidable in this Federal Reserve would not be able to keep on going. And what happened to that?
Give me the statistic again. Ralph Van Campora talking about the October low, adamant. That's when the Dow Jones Industrial Average hit the low. John, you mentioned September, and you mentioned the European banks are up a ginormous amount.
Since the summer, sure.
Or the miners.
Take the miners from the last 3 months.
Yeah.
The lows of China in October. Alibaba's up like something 75, 80%. something like that, Tom. We've had a big rally off those lows.
And Curran writing up with Tom Orlick and team on China today, and to me that's another big mystery we've got. I mean, I'm sorry, but 3% China or 5% China is a huge debate into this Fed meeting and the following Fed meeting.
There's a hope, there's a fear. The hope is you import a ton of demand if you're Europe. The fear is you import more inflation. And that's the conundrum. What does that look like in a couple of months' time, Tom, by year end? I've got no idea. But that ultimately is what everyone is fixated on for good reason.
In Bramo, it's suitably a Bramo conundrum.
That is the Bramo story for 2023.
It is the Bramo story.
So everyone's excited about the good stuff from China. And Lisa's like, no, let me tell you something.
I'm sitting here worrying all about that. I can tell you about it later.
Let's get through the data quickly here to get to Michael Bell in London. John, I'm going to look at the sum of what I see here, which is still accommodative into the Fed meeting, but a little bit more restrictive the last couple of days.
It's a two-part story, Tom. Financial conditions have eased over the last month or so. Maybe more than that, longer than that. The Federal Reserve Chair will be asked about that. If he says it's an unwarranted easing, the next part of the conversation is, OK, how does the market respond to it? Because this market's been ignoring Fed officials to some extent over the last few months.
Michael Bell joins us right now. He is in London and with JP Morgan Asset Management with Parchment from Queen's College at Cambridge. The guy holding court at Queen's College right now, Michael Bell, is Mohammed Al-Arian, and he would talk about the game theory, the T decisions of the moment. What is your key T decision for JP Morgan Asset Management with the flow of news we have in the next 10 days?
I think ultimately we're going to be focused most carefully on employment numbers coming out of the US, particularly looking at whether we get weakness in construction employment, because we've seen severe weakness in home sales, particularly existing home sales, down pretty close to the 08 lows now. Historically, with a bit of a lag, you would expect that to feed through into weaker home starts, which is happening. And then with that, some construction job losses, which then tends to spill into a broader decline in overall employment. So it's those construction employment numbers that I'm watching most carefully.
Mike, when we get to March and the Federal Reserve meeting, Tom said, I think it was, what, Tom, March 22nd?
22,
March 22nd.
Yes,
Mike, when we get to March 22nd, where do you imagine the data is going to be? And would you see sufficient reason for this Fed to say, that's enough?
I think there's a good chance that they stop in March. There's a question mark as to whether unemployment has actually gone up by then. But I do think my base case is that we are going to see probably around the sort of middle of the year unemployment rising in the US. And that's going to then give the market confidence that the Fed can deliver the cuts that are being priced at the moment.
Given the fact that we just keep wringing our hands and talking about how uncertain everything is and we can't really forecast or see very far out, how do you hedge, right? How do you sort of tentatively position at a time when potentially there are still big gains to be made, and yet there is so much uncertainty?
Well, I actually think the biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high, and the Fed, having maybe paused for a bit in March, then in the second half of the year, they actually end up putting rates up by more than is forecast and aren't able to deliver the rate cuts that the market's expecting for 2024. So, you know, in that world, unfortunately, you're back into a world where both bonds and stocks would go down together. So I think you need to hedge using options rather than your kind of traditional diversification play.
Do you think that that's a likely outcome?
But it's not our base case.
Do you think that's a likely outcome?
Our base case is that you're going to get a recession in 2023. That will allow wage pressures to moderate, and then that the Fed can actually cut rates in 2024. My best guess is the Fed are going to bring rates down to about 2.5% by the end of 2024, which of course is broadly in line with what the market's pricing now, give or take.
So, Mike, that's the US. If I could just jump in, can we just quickly squeeze in Europe and China as well, Mike? Where are you on international equities after 10 years of going around saying, finally, going to see some international outperformance? I say 10 years, I exaggerate, but you know where I'm going with this, Mike. When do you think we finally start to see international outperformance? And what do you see on the table right now that tells you some of these moves are durable?
So I'm pretty bullish on China. I ultimately think that, yes, it's rallied a fair way off the lows, but let's not forget it had gone down more than 60% from the peak, and we're still down about 40% from the peak. So I think that we're going to see a pretty V-shaped economic recovery in China in the way that we did in the West when economies reopened there. And I think that that's been partly priced, but not fully priced yet. I went around the country in Q4 of last year, and the amount of pessimism that I experienced from investors on China was really quite unprecedented. And so I think there's a lot of people who probably haven't closed those underweight positions yet. And as they capitulate, as China data continues to be supportive, I think you'll see Chinese stocks move higher throughout this year, although always not in a straight line, of course. Europe, I think, is interesting because there have been two fundamental improvements. Obviously, we've seen the reopening of China, which helps the Europe story, but also the massive decline in gas prices, down sort of 60% since September. But the problem is the market's reacted a lot to that already. So you were talking in the intro there about the sharp rally we've seen in European banks. I mean, both European and US banks were down 35% in October. The US banks are still down 25%, but the European banks have rallied a long way. So I'd have a preference for things like US banks over Europe at the moment, given how far Europe's rallied.
Mike Bell. Mike, great to squeeze that in. Fantastic to have you. Mike Bell there of JP Morgan Asset Management on the banking system in the United States and Europe. SX7E to get the European banks up, the banks in the Eurozone. That's the index. The low was in July. And since July 14th, Tom, we're up 51.3% on the banks in the Eurozone. That's a rally.
Well, some of it's beat down, but the rally also is a broad sense of stocks. And again, I would say just as a general statement, there's a real belief that there was a lot of gloom in shorting and, just gloom, forget about the shorting. And we've made that up. And the whole now what is to me just critical. And you see that in chart after chart where we're up against, and typically moving up, we're up against some significant resistance. How do we break through that? What's the metric that signals a breakout?
Yeah, the IMF getting us all excited with 0.7% GDP growth for 2023 in the Eurozone. The good news is it's not zero and it doesn't have a negative before it. But ultimately, it's the same old conversation after a rally, isn't it?
Well, is it? And especially with the European banks, which are up more than 15%. I was looking at the annualized equivalent, which would be more than 400%. We're not counting on that. It's not a straight line. But I am curious about how much of the bad news that was baked in for so long was because of negative yields, negative rates, and how much they actually stand to benefit from true yield, true income, true investment opportunities that can actually give them some revenue stream.
You would hope, because they've been complaining about that for a long, long time. What was it Mike Schumacher said of Wales? He said it's been like 20 years and there's been no growth in Italy. Why would that change?
Well, and then people have been complaining about higher rates, and then that's denting businesses.
I think he continued that forward. He said in Italy there's been no growth and no World Cup team.
Yes, I know. Okay.
I think he...
I'm surprised you haven't taken digs at me about AC Milan in the month of January.
They're struggling. They're struggling.
That's why we haven't been together.
That's what doing a Tottenham.
Restarted after the World Cup, Tom, and that team... Wow, if they lost some momentum. That is just ugly.
We call that doing a Tottenham.
I've offered my services, to go and consult them.
I have not offered my services to Tottenham.
Haven't you?
No.
You sure they don't want them, Tom?
No, they said to me, you can be a guy that sells the food pies.
You would be the guy that I came to in the transfer window. Like, who should we buy?
Oh, yeah.
And then you'd...
Is that going on right now? I see a lot of bodies moving around.
That's closing soon.
When they have those huge numbers, is that money to the team or money to the player?
No, to the team.
That's bizarre.
It's not like baseball.
It's totally
goes, and then the player gets a separate contract.
Do they make
Then the agents get all these different cuts, and it's pretty impressive stuff. We're in the wrong business, aren't we? Wouldn't that be fun? We'd be football agents. How do you think that would work out? Can you imagine? That'd be great, wouldn't it? All right. Seth Carpenter and Morgan Stanley coming up shortly.
Endorsement in Greer's or Greg's or whatever it's called.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Eurozone is on track to avoid a recession. The region's economy unexpectedly grew by 0.1% in the final quarter, despite double-digit inflation and Russia's invasion of Ukraine. Output in Germany and Spain shrank, but France and Spain recorded expansions. For the first time in a year, the International Monetary Fund has raised its global economic growth outlook. The fund says the world's gross domestic product will probably expand 2.9% this year. That's 0.2 of a percentage point higher than the October forecast. The outlook was boosted because of resilient U.S. demand and the reopening of China. The U.S. and South Korea plan to step up the scale of military exercises that have angered North Korea's Kim Jong-un. The drills had been scaled down or halted under former President Trump. In the past, North Korea responded to the drills with threats and weapons tests. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
A pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
I know we can forge a path of building an economy where no one's left behind. It's about making investments in America's cities, towns, heartlands, and rural America. It's about making things here in America again. It's about good jobs. It's about the dignity of work. It's about respect and self-worth. And it's about damn time we're doing it.
The President of the United States, Lisa, tells me he's coming to New York today. Is that right?
He is. 11:45. He arrives on Wall Street. So if you want to move around the city, you might want to do it before that.
Yeah, farthest under Manhattan problems.
Exactly.
It's a bit 100%. Of a New York bias, but, you know, there's no love here for when the president comes to town.
So, true story. I was reading about him coming to town yesterday, and my son was there, and I was like, oh, Biden's coming in. He's like, why do you say that? And I'm like, have you ever been on the streets of Manhattan when the president comes in or the UN is having a meeting? All right, I'm going to stop.
Yeah, Fifth Avenue and Madison, so they can speed in and
I
out.
didn't realize until this morning, and now I'm just like, oh, for goodness sake, can I go?
New York Post with a nice summary here. I've just been skimming through here. Mr. Schumer, I guess, will be there. Total Hudson Tunnel cost $16 billion. This is a tunnel under the Hudson River. After the big dig in Boston, I'd go, maybe they'll nudge that higher over time. And what's really important, John, 12,653 minutes of delay they have had. And the New York Post knows that John Tucker of Bloomberg Radio, that was in 2020. In 1 year, they had 12,653 minutes of delay. And right. John Tucker personally experienced 8,367 minutes of that delay.
Do you have any comments on the infrastructure in New York City? Do you have anything to say? Do you know what he used to do to me when I came over?
What?
When I first came over, Tom and I would be on air together. He'd sit down, and he knew exactly what he was doing. He was trying to get me in trouble with the audience. He would turn around and say, so tell me, what's your experience of the infrastructure compared to London? What do you think?
Come on, that's not fair.
What do you think? He would do it every single time.
We used to
every
say,
single time.
Growing up, that you know how they say pothole in some places that actually have nice streets? Before you get a pothole, they should just put it before New York City. Just a really big sign, pothole.
I will
say
this, and this is from Boston. I can't find words for the first glance from Boston Center across to the north end when they took out the expressway, the 6 lanes of elevated highway across the Rose Kennedy garden that's there. And I knew everything about it. I knew all the math, Tip O'Neill Jr., blah, blah, blah. And none of it mattered for the impact of when they did that infrastructure project in Boston. I was stunned. Like LaGuardia now, we're all stunned at this dump of an airport. Looks gorgeous. What is that tunnel going to do? What is that tunnel?
I do not understand still why JFK is the dump that it is. I just don't get it.
My amateur take is with LaGuardia, they gave the unions equity investment. If that's what it takes to do it in America,
sure,
that's what you're going to do. It's an outrage compared to what you have in England
and
or in continental Europe.
Yeah, without a doubt.
Yeah. I mean, it's just terrible. I mean, there's no other way to put it. I think you look at all the expressways of Long Island, and they're an absolute disaster. And Amory Horton has been stuck on all of them and joins us right now, our Bloomberg Washington correspondent, not traveling with the president today. To Baltimore in infrastructure, to New York in infrastructure seems to be a habit. What's going on here? What's the real backstory, Anne-Marie?
Yes, and also this week, him and the vice president will be going to Philadelphia to talk about infrastructure and clean water. You could say the president is just getting out of Washington and making sure the American people know about his legislative wins, but obviously that looks like campaigning, and that's probably what's going on behind the scenes. This is a president that is preparing to make an announcement for 2024, and what better way to do that than being the executive right now, being the president of the United States, and going out and explaining the legislative wins you've had, which was a bipartisan agreement when it comes to the hard infrastructure. And this is the kind of legislative work that American people like to see. They want to see you fixing railroads and tunnels and bridges. So that's a win for the president.
Okay.
It also sets him counterpart to what's going on in Congress, particularly in the House.
Baltimore, Democrat. New York City, Democrat. What kind of infrastructure do Republicans want?
I mean, infrastructure, Tom, I think wins across, right? You could say these states and cities are heavily Democratic, right? But these are also main GDP drivers of the United States. I mean, if you look at least for New York, this tunnel that they want to build under the Hudson, when you look at who goes in and out of New York City on any given day, pre-pandemic, that number is about 900,000 people. But also, the president was recently with Minority Leader Mitch McConnell talking about a bridge in Kentucky. So, yes, what you're seeing this week is a democratically leaning states, but at the same time, he has also gone on the Republican side. But to my point, that this is a president that wants to prepare for an announcement of 2024. After he talks about one of his favorite things in the world, railroads, he's also going to be going to a campaign event, right, in terms of for the DNC. So that also makes sense why he'd be going to some of these Democratic leading places.
To basically cheer on the past victories and look toward a future run. In the meantime, in Washington, D.C., overnight, a lot of people talking about the potential banning, cutting off American suppliers from exporting goods to Huawei Technologies. There's a sort of domestic push on both the domestic front as well as the international front in terms of isolating China. How realistic is this? Is this really gaining steam?
Well, this was a great scoop by our Jenny Leonard, and we should really just give a little bit of context about what is already happening with Huawei in terms of the Commerce Department. So the Trump administration had put Huawei on a U.S. entity list. So pretty much all advanced technology could not be sent from U.S. companies to Huawei. And then you had the likes of Intel, Qualcomm, there's like these lobbying groups. They wanted to make sure that at least some old tech was able to go to Huawei. Now that you can only do that if you're one of these companies if you get a license. So right now there's going to be a pausing on the licenses from the Commerce Department. And then you have hawks in the administration talking about the fact that maybe this is too much of a carve out. And they're saying we should ban all of the technology that the likes of Intel or Qualcomm send over to Huawei. So this is getting a lot of attention in Washington, D.C., and it also comes as you have, a divided Congress, but a Congress that very much so is putting pressure not just on their own colleagues in Congress, but also the administration to take an even tougher stance on China.
AMH, thank you. Anne-Marie's such a New Yorker, Tom. She knew that when the president comes to New York, you don't come to New York. And she stayed down in Washington, D.C.
Yeah, she does. I mean,
that's just like the rules.
She's gifted. I mean,
she gets it.
She gets it. This tunnel thing, I mean, Lisa, literally the discussion's gone on for what, 30 years?
Yeah, I was going to say, this is a long time coming.
For our international audience, they've yet to move the shovel once, right? Am I right? It's really...
This is going to kick it off. This has been a real sore spot.
Back to 1910.
We need to rebuild infrastructure. To your point about why it's so hard, how do you build infrastructure when you already are using a lot of the stuff, right? Like LaGuardia was a pain in the neck to get to when they were building it because you had to go in through another area and go to a separate section to get a taxi.
Crazy,
and So, I mean, that's the obstacle. How do you rebuild something while keeping a city operational?
Can we do the subway next? Can we do that next?
Sure. I'll make a call.
Just clean it up, Bramo. Just clean it up. Do you remember when they said in the pandemic that they would start cleaning the subway every day?
And you
Do you remember that? And we all turned around and said, hold on a minute. What was the old cleaning practice?
Wait. Actually, back up. You said that. The rest of us said, wow, they're going to clean it every day.
All of a sudden they're going to do it every day. What were they doing before?
Didn't you notice what it looked like?
Once a week. What was it before? Once a month? Anyway.
It's, compared to what I see in subways, is a general statement around the world.
I just don't get it. I just don't get it.
I just don't get it.
I just don't get it.
Where's the fury? Where's the will? Richard Haas was on the other day. I thought he was brilliant.
What did he say?
Where's the will? Where's the outrage? Where's, the will?
Do you want to start the outrage here?
No, I think Mayor Adams is trying to get the outrage going. The outrage meter isn't, too much.
Tom's going to be picketing around the studio. We want
seriously. Ask the
Yeah.
prima donna the last time I was on the subway, and the answer is I can't remember.
Wait, when was the last time?
There's a lot of people that have to take the subway. This is not amusing.
How many years has it been?
Oh, forever.
Like a decade?
Forever. Yeah, my people won't let me go.
We should do a trip.
I go all the time.
We'll do
I'll
a trip.
take you. I'll shepherd you.
Will you help us navigate?
Yeah.
You take the subway to Fairway, don't you?
Oh, my God.
Bloomberg Surveillance, we welcome all of you on radio and television. Futures at -6, Dow Futures -55. VIX 20.22 as we get set. 10-year yield 3.53%. I'm going to make it clear, ECI is underplayed, and for me, it is always an important statistic. It folds in wages and benefits. It is, as an amateur, it is the statistic I follow, but far more importantly, we need to speak to the pro of the nuances of this. Seth Carpenter to join us from Morgan Stanley. But first, the pro, Michael McKee. What do you got?
Well, we got the employment cost index up 1%, which is a little bit lower than the survey estimate of 1.1 and down from 1.2 the prior month. Wages and salaries increased 1%. These are all quarterly numbers, and benefit costs were up a 0.8%. So on a 12-month basis, compensation costs are up 5.1%, wages and salaries 5.1%. So not a lot of difference between that and the third quarter. This is the fourth quarter's numbers. Benefit costs up 4.9%. So at this point, it looks like we didn't see a huge change in what's going on with benefits, wages, and salaries in terms of the fourth quarter. But this is a number that the Fed watches closely. It is obviously old data, but it gives them a sort of picture of where things are going.
Markets are moving. Dive into that. Mike's here with what do you got here? I got to lean over and see. Excuse me for being 47 pages of data on ECI. He's going to dive into the data. I'm going to tell you markets turn.
Yeah.
And of course they turn here, Lisa, into Fed Day. Tomorrow we go green on the screen. SPX up 4. VIX comes in as well. But the yield space is really where I see the movement. 3.51% in 3 basis points now. Lower yields is the construction coming off this data, and the dollar with a little bit of a bid.
Yeah, the fear had been that what happens if the employment cost index comes in hotter? It did not. The opposite. It surprised to the downside, which perhaps on the margins takes pressure off the Fed to raise rates even more. You see the yield come in not only on the 2-year space, but also even more so on the 10-year space, raising questions about longer-term inflation.
What do you see, Michael?
Well, if there is some good news in here you want to pull out, you take a look at the composition here of the wage gains. Goods producing industries were up only 1%, down from 1.3%. Not a surprise, given what's been going on in the sectors in terms of hiring. But service producing industries also up only 1%. And that's the area where the Fed has been looking for a lot of inflation. So maybe there's a suggestion that inflation in the service industries has fallen just a little bit in terms of wages. And that's what they want to see.
Does this change your press conference? Does this change the Fed meeting tomorrow?
It doesn't change the press conference.
Come on, give me some theater here, Mike.
It changes everything, Tom.
Everything.
You did a great job.
Instead of what everybody thought they'll do, they'll raise rates 25 basis points. Jay Powell will come out and say, we need to keep rates higher for longer. That's kind of, I think,
very good.
What we'll see with this big change.
It was okay. It was Oscar-worthy. Michael McKee with us, and of course, front and center tomorrow with our economic coverage. We take this data. It's maybe the province of Ellen Zentner, but we'll take it on a more global scale with Seth Carpenter, Chief Global Economist at Morgan Stanley. Seth, I want you to fold, and I know you're going to read Ellen Zentner and her team here as they analyze ECI, but I want you to fold it into the great China call, which Morgan Stanley, back to Steve Roach, is expert on. Is China a 3% story, or is it a 5% story that could make things more complex for the chairman of the Federal Reserve?
Wow, that is a fantastic question. Clearly, the China reopening story is the big narrative going on right now in markets. And, we've been bullish there. I think we're above consensus, 5.75%, maybe a bit more in terms of how much growth we'll get for China this year. Very bullish for us. The reopening is notable. I think, though, when you talk about spillovers back to the U.S., when you think about what it does for Chair Powell, they're probably a little bit less dramatic than you might otherwise think. Clearly a big story for people who are investing in China and the region. But the spill back to the U.S., in terms of inflation, isn't going to be quite so big right now. We import a lot of consumer goods from China, but we know that consumer goods prices have actually been falling for the past couple of months as people have pulled back and redirected their spending. We also know that China had done a lot during COVID-0 to shield some of that production for exports. So the first order impact on inflation for the U.S. is actually going to be a little bit muted. The surge in demand there in China, domestic spending, especially domestic consumer spending on services. So the read-through this time around, this cycle, is going to be a little bit less.
Seth, I want you to dovetail a Morgan Stanley stunning 5.X% China growth call with U.S. disinflation. You and I follow Edward S. Hyman of C.J. Lawrence and Evercore ISI, and Ed Hyman's dovetailing a China call like you with substantial U.S. disinflation. Do you agree with that premise?
I think substantial probably overstates it a little bit. We are optimistic about inflation coming down in the U.S. We have it getting to below 3% by the end of the year. And just a quick shout out, you mentioned Ellen Zentner, our fantastic U.S. economist. Robin Xing is our stupendous China economist. And luckily, they're both on the same page here. The disinflationary push from goods inflation is clearly there in the data, and China is a part of that. But like I said before, the difference is going to be smaller than I think you might otherwise think. It really is this retrenching. And we saw it, for example, in automobiles. First, Tesla announced they were cutting prices. Rivian followed. Ford announced they're following it on electric vehicles. Adam Jonas, our autos analyst, points out that in the current situation, electric vehicle prices tend to drive pricing for new cars. So a lot of the disinflation that's going on from goods was already there, already starting. China helps at the margin, but I don't think it's going to be the defining story of the disinflationary trend.
What's the risk then, Seth, that perhaps people get overzealous by the decelerating inflation, the disinflation that we're seeing so far this year? Take the Fed off the table. The Fed does pause with rate hikes, and then inflation stays sticky, and they're forced to reignite and raise rates once again.
I think that is a risk that a month or so ago was dramatically underappreciated. We've tried to flag that risk a few times in our pieces. And so, yeah, the scenario you lay out, I think, is a plausible one. It's not at all the highest probability event, but it's, the next couple of months are very benign. But then non-farm payrolls go back up to 200,000 and inflation doesn't break through below 3.5%. I think it's a risk. I'd say it's not a very, very high risk, but it's one that investors have to keep in mind. And the only way we're going to know for sure is monitoring the data.
In the meantime, as we get the drip, drip, drip of the data, as you talk about, what are you looking at in terms of the components, the underlyings of some of the employment cost index or what we get with payrolls on Friday to get a sense of how sticky this disinflation is?
Yeah, I think all of those plus the CPI data are first order important, especially for the Fed. So we've actually got a house view that's a little bit dovish relative to markets. Like everybody, we expect 25 basis points at this meeting, but after that, we think they're going to be done at the Fed. The only way that happens, but we think it is the path that will happen, is if we get non-farm payrolls coming down well below 200 and looking like they're going to 100,000 and in fact below 100,000.
Seth, I think we described now is not in the textbooks. We're coming out of all the pandemic and supply side dynamics, and maybe we're getting back to a more traditional monetary analysis. And around that is not the question, is Jerome Powell central banker to the world, but more nuanced is, in what way is the chairman of the Federal Reserve central banker to the world?
Yeah, I mean, a few things. It's clear that what the Fed does matters, and it matters a lot for the global economy. Interestingly enough, this cycle was a little bit different in a number of ways. If you think about some of the EM economies, especially in Latin America, we saw, for example, this Brazilian central bank start to raise rates in anticipation of the Fed's hiking cycle. They got out a little bit in front of it. Some of the other EM central banks have been similarly defensive. And so there's actually been a little bit less of a negative spillover to other economies than you might have expected in some preceding cycles. But there's no two ways about it. We saw the yen for a while depreciate really aggressively. We saw the euro depreciate very aggressively. What the Fed does has critical importance for the rest of the world.
So let's talk about what you expect the Fed to do. You said that you could see jobs go down to, say, sub 100,000 in the next couple of months, allowing the Fed to pause with the rate hikes. What are you seeing in the fundamentals, in the corporate earnings, to give you a sense that we are going to see that massive and sudden drop-off in job creation?
Excellent question. And first, I want to preface it that even though we think this week's Fed meeting is going to be the last rate hike, I don't see any way at all that Chair Powell and colleagues are going to indicate that it would be the last hike. In fact, I suspect they believe it will not be the last hike, and it's going to take the data coming in as soft as we think that they will before the committee actually starts to change its mind. So the rhetoric, I think, stays on the hawkish side, which I think is similar to what Mike had said just before the segment. So then what else is going on? Again, I don't think the slowdown that we're calling for in non-farm payrolls is all that dramatic. The last print was 230 or so. It's been this consistent decline in non-farm payrolls that we think continues and gets down to a really soft run rate. Chair Powell keeps talking about wanting the economy to grow below potential for a while, and that's what we think it takes.
Seth, thank you so much. Seth Carpenter is with Morgan Stanley. Markets lift on the ECI news. They come back down to red on the screen and now relift up to new highs for the day. Futures up 7, Dow futures up 47. Lisa, I want to sell forward to Thursday. And Robert Schiffman, who's fabulous at Bloomberg Intelligence, on the debt side and the cash flow side of these tech juggernauts. I mean, his headlines are simple. He says, look, their cash flows are resilient. I love this headline. Microsoft to lose AAA rating, time for a $50 billion bond issue. Amazon's financial trouble, firing thousands, borrowing billions. Tech bonds going wild. I love that. Apple's $1 trillion milestone. Shareholder returns keep growing. Schiffman, from a bond purview, screaming tech optimism.
From a cash flow perspective, these are juggernauts, as you said. These companies are minting cash. The question really is the valuation. Have the valuations gotten ahead of themselves during a free money era, during the pandemic? And really what I'm noticing, based on the fact that you're basically seeing flat trading on Apple and Amazon after the ECI report, how interest rate sensitive these names still are. Interest rates lower, tech names higher. That has been the theme, and it continues to be because of valuation.
I mean, if you generate 100, the number's so big I can't say it, $100 billion in free cash flow, that is a conundrum. I mean, that's something to worry about.
Which country are you going to buy?
I don't know, maybe buy the Boston Red Sox and fix things. That was Apple's free cash flow. Stay with us. A lift to the market off ECI. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve officials are on track to consider pausing interest rate hikes after next month's meeting. That's if there's more evidence that inflation is cooling. The scenario is based on a timeline sketched out by one of the Fed's most closely watched hawks, Christopher Waller. Policymakers are expected to raise rates by a quarter point at the end of a two-day meeting on Wednesday. The White House will end a pair of COVID emergency declarations on May 11th, and that will mean the end of the controversial Title 42, a policy that expanded expulsion powers at the border of the U.S. and Mexico. The emergency declaration also allowed millions of Americans special access to Medicaid, the program that provides health care to low-income people. General Motors expects its earnings momentum to grow this year. The automaker reported better than expected profit in the fourth quarter. GM is counting on continued demand for its highest profit margin SUVs and trucks. It's also expected higher production levels as supply chain issues fade. United Parcel Service forecasts sales below Wall Street's estimates. Now the package courier is struggling with a drop in volume as shoppers return to stores. Meanwhile, inflation is cutting into spending habits. And Boeing will deliver its final 747 today. A cargo version of the jumbo jet will be turned over to Atlas Air. Over 5 decades, more than 1,500 747s were built. The plane would carry more than 500 passengers, and it's Boeing words, it shrank the world and democratized air travel. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
To what extent are these big technology companies laying off employees but still outperforming against expectations? So I think that these layoffs put these companies in a position where it's more difficult for them to show better than expected sales and profits. Because if they had better than expected sales and profits, why are they cutting headcount so significantly?
Tom Forty with D.A. Davidson there on the tech path forward here. Lisa, just quickly looking at the markets, a lift off what we saw with ECI futures up 9.
Basically, if you have less inflation pressure than expected, you have a lift to markets, bond yields lower, stocks up, and that is the story so far of 2023.
Right now, we're going to dive into the streaming era. It's always fun to do this with Paul Sweeney on Bloomberg Radio as well. Brian Weiser joins us now, principal at Madison and Wall. His great work with WPP over the recent years as well. And what's so unique about Brian Weiser is he has been a great supporter of television and traditional media and traditional advertising. It was everybody else says it's going to blow up. And yet you said before we went on air, maybe now's a time where there's some real challenges.
Yeah, I mean, Bob Iger said it well before he went back to Disney. TV is at a precipice now, and there's a real problem because we're 2 years away from less than half of the country having pay TV. Yeah. Less than 50% pay TV penetration in 2 years. It'll make it almost impossible for traditional advertisers to meet their goals through television. That's a new thing. That wasn't true a few years ago.
And I failed, folks. I said, I think 10 days ago, I was going to watch Wednesday just to keep up with the zeitgeist, but I haven't gotten there yet. Are you watching at home?
No, I'm waiting till tomorrow. So,
but
I'm bumping. All right,
watch
go on.
Wednesday as well. But the fact of the matter is, Jon Favreau invented this wonderful Mandalorian, and I'm sorry, Disney Plus needs Mandalorian to win. Is that all this has come down to? Is you got to have hits?
All the investment that's going into the streaming services will produce more hits, and most of it will not be ad supported. Fundamentally, most people will still choose the ad-free options for most of these services.
So we get Meta tomorrow, we get Alphabet or Google coming out on Thursday, Disney coming out the following week. What are you looking for? What's going to be the theme of this particular media reporting season?
I think the gap between the narratives that we'll see versus the reality will be the main thing I'll be looking for. By that, I mean, we're going to see a lot of negativity in the numbers because you're going to see a Meta that'll have soft, maybe negative numbers. Google will probably be negative as reported, but people are going to forget about the currency effects because that's going to be a 5 to 10% headwind depending on the company. Underlying advertising growth will probably end the year 2022 in a pretty positive position. You saw Spotify this morning, 14% as reported growth in euros, 4% in constant currency. 4% is a more realistic number to think about, but we've got to be conscious of the currency effects and how that's going to impact the narratives.
So let's put some numbers to the currency impacts. This one agency, Kyriba, came out and said that North American companies lost about $43 billion from July to September, an all-time high due to the currency fluctuations. So to your point, this is a big headwind that might be turning into a tailwind this year, considering what we've already seen.
It'll change the narrative because here we are in an economy that's actually growing, despite, I think, a lot of expectations of more negativity. You see the Europe numbers today. We saw the U.S. numbers before. And the reality is that underlying economic growth is still happening. Inflation is additive. Inflation actually adds to advertising growth, right? And so you're going to see a mid-single-digit advertising market, not negative numbers. And so there's going to be a gap between the headlines, which are going to be as reported in USD, which could be negative, but constant currency will actually be positive.
I usually don't do this because I just don't spend time on Meta, Facebook, whatever you want to call it. But you are the genius on this. You and Kudrowski and Kirkpatrick and the rest of them, you three were way out front on the challenges and then the huge success of what Zuckerberg did. Does he need a new CEO? And is that going to be the surprise here to get Facebook to launch up 60% to get back to its 2021 high?
That's a good question. I mean, the reality is that Zuckerberg is the CEO. Will he change his orientation around the metaverse? I mean, that's probably one of the bigger issues because if they want to grow their advertising business, they're going to have to find ways to invest into new areas. They're so big inside of digital advertising, there's not a lot of room for growth. Can they invest into different spaces if they want advertising growth? That is the thing they have to do. I think you have to decide on that strategy before you choose a different CEO. If they think that the metaverse, as they've characterized it, is the right place, Zuckerberg might be the right person.
He's the only one I know, Lisa, that could say metaverse and I don't break out in smiles. Are you kidding me? What in God's name is the metaverse?
Well, to be clear, I don't think that it's a place I would be investing in right now. I mean, if you're talking about $10 billion a year, for however many years to produce uncertain outcomes. But if you believe that the CEO has a clear view about what exactly it is,
what is the metaverse? You're the genius on this.
I don't know. It involves legless avatars floating around.
You and Kirkpatrick are sitting here at a table, and we're having a navel-gazing interview over the metaverse. Come on, Brian, what is it?
I don't know.
Thank you.
All I'm saying is, if you believe that the CEO has a vision for what exactly it is, you're betting on that CEO. So you say, should he change CEOs? I'm saying, I don't think anyone else would have the same vision he does. He might be wrong, but no one else is going to execute as well as he would.
So, Tom, you will come over someday, and my offspring will explain to you the metaverse because they are well versed in the metaverse, and they understand potentially why it makes sense to have currency.
Right?
And, well, it's Roblox. It's a whole ecosystem that is in the ether, sort of in the cyber world, in the cybersphere. But then there are actual, tangible, real-world things that can transact. Look, I've got kids. This is what happens.
Apple may very well get there faster first with something more realistic.
Correct.
Right? Because of whatever VR, AR evolutions we get, they'll probably drive it in a more palatable way. Snap as well. When Snap reports earnings today, keep an eye out for whatever they say about all their work in AR is actually an early stage version of where this goes.
Are beginning to a bionic future. Just discussing the macro picture, I am curious about the interest rate sensitivity of this sector, because what you're talking about, we are still seeing single-digit growth. It isn't Armageddon by any means, but the valuations are pricing in really rapid growth on free money for a long time. That's what it was. So at what point do the earnings not matter? Does it really hinge on the macro picture?
Yeah, I mean, here's the thing. Interest rates now are about where they were, through most of the 90s, which was a pretty good era, as far as I recall, for advertising and for media, generally speaking. You can have mid-single-digit levels of cost of capital and still have a growing industry. I think you end up killing the frothy things, the rapid delivery businesses. I came up with all these crazy ideas for what I would do with $1 billion of free money on our podcast I was publishing previously. And I mean, the point is that that's not realistic.
20 seconds. What does WBD do enjoying 65.7% debt?
I mean, here's the thing. They are starting to sell themselves off for parts. You saw the selling of the music part of the movie studio. They'll probably find other pieces to sell off to pay that down as much as they can.
Brian, thank you.
Thank you so much.
Superb.
Thanks very much.
Madison and Wall. Are you going to do
Madison and Wall? Madison and Wall.
Are you going to do buy, hold, sell with Madison Wall?
No, Madison and Wall is a consultancy, strategic consultancy to companies, financial institutions, and others.
Okay, very good. Brian Weezer with us here on streaming and the rest of it. You impressed the hell out of me there with the metaverse. Is that the thing
I had these
where
debates.
You do this thing?
That's virtual reality, but the
do you
metaverse.
Do that at home?
No, I don't. I mean, maybe my existence is
Ferro
that. You know, we
that
can discuss that. I really doubt that. That's just not true.
Oh.
Yeah. Can you do that one more time?
Ferro's looking, oh my God, 18 goals in January.
You know, this is the discussion among a lot of, people who are younger. If you look at Snapchat even, you can see your friends' avatars in different places, right? And so you can go meet them where they're at, which is basically a meetup app for people in a certain network. So what's to say you couldn't meet up in a sort of virtual way and on the ground way? I mean, these are all the discussions that are going on.
It's going to have to see.
You're like, not in my household.
I'm a fossil on this. I won't let the games in the house. The Sony stuff and.
It's not on Sony stuff. It's not on those things.
Know.
It's all on the phone. So they're probably doing it anyway.
Yeah, no,
unless you have a much better handle on it.
Can we talk about a market lift here into the 9 o'clock hour? It's a nice market lift. 10-year yield in 4 basis points, and futures up 12 as a lift here. We're at 4,043 SPX, 33,800 in the Dow. I'm sorry, it's a move.
If you just are joining, the employment cost index coming in at 1% of a gain year over year in the fourth quarter versus the 1.1% expectation. So just moderately softer than people had expected, and that's what's really driving the gain.
I'll ask you, did we all get along today and sing Kumbaya so we can do this tomorrow? It's the first time we've been back together since time began.
I think we might have managed to muddle through.
Early. We left it off.
It's nice to have you back.
Yeah, Brian, thank you for. Oh, me back. I thought you meant Brian Weezer.
I was actually talking to you, but Brian, it's nice to have you here as well.
I'm gonna tear up here as well.
Yeah, exactly.
An important conversation as he spoke to the chief financial officer of General Motors, David Calhoun. Much to talk about. He's the Boeing Chief Executive Officer. Look for that this afternoon. Stay with us on radio and television. This is Bloomberg Surveillance. Good morning.